hearing will come to order. I would like to begin with an announcement. I'm pleased to announce that Mr. Seth Moulton is designated as the new Vice Chair of the committee. I look forward to working with Vice Chair Moulton and welcome his leadership. And now I want to welcome everyone to the Budget Committee hearing. This hearing will focus on the impact of the 2017 tax law on the budget and on American families. I especially want to thank our great panel for being with us this morning. Today we'll be hearing from Dr. William Gale, R.J. and Francis Miller Chair in Federal Economic Policy at the Brookings Institution and co-director of the Tax Policy Center. We'll hear from Chai-Ching Wang, Director of Federal Fiscal Policy at the Center on Budget and Policy Priorities. We welcome Caroline Bruckner, Professor at American University and the Managing Director of the COGAD, Tax Policy Center, and Lana Paul, President of Greetings, Inc., headquartered in Pella, Iowa. Now I yield myself 5 minutes for my opening statement. Once again, welcome to our witnesses. I want to apologize this morning to everyone here. We tried to find a tax expert named Michael Cohen, thinking it would generate more attention. We were unable to do so. But again, we have an esteemed panel. We are here today to talk about the impact of the 2017 tax law on the federal budget and American families. It's a conversation my Democratic colleagues and I tried to have with our Republican counterparts more than a year ago. But instead of collaborating on bipartisan, middle-class focused tax reform, and instead of heeding the warnings of economists, the Congressional Budget Office, and even our own constituents, congressional Republicans chose to enact massive tax cuts for the wealthy and large corporations, which we will discuss today. They did this on their own, behind closed doors in the dead of night, and without time for debate or any public scrutiny, and I exclude all my Republican colleagues here. I don't think anyone here was involved in that process, although most who were here did vote for it. That bill was enacted in such a hurry that senators were forced to read handwritten changes in the margins of the bill text, if they had time to read it at all. That's one of the reasons why there have been about requests for more than 70 corrections to the tax bill coming from Senate Republicans, at least. This tax law was based on the flawed notion of trickle-down economics, which has totally been discredited. The idea that tax cuts for the wealthiest Americans and for corporations will trickle down and raise the standard of living and incomes for everyone else. We know that hasn't happened. Under the Republican tax law, nearly all the tax cuts are going to the top 1% and corporations. The richest 1% alone are receiving more than 80% of the total benefits. Our long-term economic growth trajectory has not improved. The federal deficit is soaring as corporate tax receipts plummet. There is no sign of an investment boom. Wage growth for workers remains weak and woefully inadequate. Most small business owners have seen few, if any, benefits. Because of changes in this law, factories and jobs are more likely to go overseas. There are even more special interest tax loopholes for the wealthy than before. And that promise of being able to do your taxes on a postcard, well, we're still waiting for that one. Since the president signed this bill into law, we've seen a record-setting $1 trillion in stock buybacks that make rich investors richer and fuel rising CEO pay. And by the way, about a third of the benefits of those stock buybacks go to foreign investors. They do almost nothing to improve business operations or help the average worker. They have not improved our economic outlook, and as our witnesses believe, will ultimately worsen income and wealth inequality. And due to perverse international tax incentives in the law, it's possible for companies to actually reduce their taxes significantly more or avoid paying tax altogether by generating income overseas and moving investments abroad. This endangers more than 15 million American workers whose jobs are vulnerable to being offshored. For American families, this law is a huge and predictable failure. For the federal budget, it's a huge and predictable drain. And that's because the premise on which this tax legislation was built, that it would magically pay for itself, is fundamentally flawed. As we will hear today, the GOP tax law has significantly weakened our budgetary health. It has caused more than a 30% drop in corporate receipts in 2018, with total receipts as a share of GDP falling to the lowest levels since the end of the Great Recession. This is despite healthy economic growth and a tight labor market. As we engage in our oversight function, today we will not only discuss what the impact of the tax cuts have had on the budget, but how they will impact the economy and American families going forward. Our budgetary challenges, and we have many, require smart, fiscally responsible policies, and the American people are demanding it. Today, we are going to find out just how deep the damage goes. We will look at the facts about the tax law's impact on American families, and we will set the stage for taking necessary action to move our nation's fiscal policies in the right direction. I thank our witnesses for helping us with this discussion, and I look forward to hearing from you. I now yield 5 minutes to the ranking member, Mr. Womack.
I thank the chairman for holding this important hearing, and thank you to our witnesses for being here today. By the way, in case you didn't pick up on it, Chairman Yarmouth is not a big fan of the Tax Cuts and Jobs Act. I just kind of wanted to state that for the record. I'd like to extend a warm welcome to Lana Paul, second-generation business owner from Pella, Iowa. Thank you, Ms. Paul, for traveling to Washington, D.C. to share your story with us. Look forward to your testimony. As we will hear from the gentlelady from Iowa, the Tax Cuts and Jobs Act is working. It is delivering meaningful relief to workers, families, job creators, and communities across the country after years of sky-high taxes and a sluggish economy. A little more than a year after President Trump signed the Tax Cuts and Jobs Act into law, our economy is strong again, with more than double the GDP growth seen during the Obama administration, and Americans are feeling the difference every day. Americans are seeing bigger paychecks, getting to keep more of their hard-earned money to save, spend, and invest the way they see fit. Wages and salaries increased by more than 3% in 2018, the largest percent increase in more than a decade. According to the Nonpartisan Tax Foundation, 80% of wage earners have seen an increase in their take-home pay. Americans are seeing more jobs. There are 7.3 million job openings, the most job openings since 2000, when the Department of Labor first started recording this data. Unemployment fell to the lowest level since the 1960s. In 2018, at 3.9%, and CBO projects unemployment will continue to decline to 3.5% in 2019. Americans are feeling more optimistic about the future. Consumer confidence is at an 18-year high, and according to a new Gallup poll released earlier this month, nearly 70% believe their personal finances will continue to improve next year. Job creators in my district are seizing on this opportunity. One of my constituents, Rick Barrows, runs Multi-Craft Contractors, a construction and industrial services business with roughly 700 employees. In talking with Rick, it's clear how the Tax Cuts and Jobs Act has made a meaningful difference, not only for him and his family, but for all of his employees. With lower taxes, Rick was able to double the employer contribution to his employees' 401ks. He was able to invest in leadership and workforce development. And with the ability to immediately write off the cost of capital investments, Rick was able to dramatically expand his operation, acquiring and renovating an adjacent property, ensuring his business can continue to grow. Now, these are the real-world benefits that I'm hearing from back home. Despite these successes, some of my colleagues on the other side of the aisle are looking for ways to reverse this progress and increase taxes on hardworking Americans. Also, they can pay for more expensive government-run programs. As we recently heard from the CBO director, Dr. Keith Hall, these efforts are likely to have significant negative consequences for our economy and constituents we represent. All of us are sitting on this dais today have a responsibility to get our fiscal house in order, and raising taxes that will stifle growth and investment is not the answer. As I've said before, we don't have a revenue problem. In fact, quite the opposite. With the Tax Cuts and Jobs Act, federal revenues in fiscal 19 are expected to increase by $186 billion. What we have is a spending problem, a fact many Democrats are choosing to ignore. Today, mandatory spending accounts for about 70% of all federal spending. Without taking into account proposals for massive new trillion-dollar entitlement programs, mandatory spending is expected to increase to 78% at the end of the 10-year budget window. I hope that our discussion today illuminates for my colleagues on the other side of the aisle that the Tax Cuts and Jobs Act is helping local business owners like Ms. Paul to create more jobs, increase paychecks, and create more economic opportunities for families. And to truly address the fiscal challenges facing our nation today and future generations, we must tackle the core driver of our ballooning debt. That is out-of-control spending. With that, Mr. Chairman, I thank you for the opportunity, and I yield back my time.
I thank the gentleman, and in the interest of time, if any other members have opening statements, you may submit those statements in writing for the record. Now we will begin our testimony from the witnesses. I first yield 5 minutes to Dr. Gale.
Chairman Yarmouth, Ranking Member Womack, members of the committee, thank you for inviting me to testify this morning. As was mentioned, I'm affiliated with the Brookings Institution and the Tax Policy Center. My statements today represent my own views, not those of any institution. The 2017 tax cut was the biggest overhaul since 1986. It definitely made some needed changes to the tax system, but my overall assessment, based on my own research and that of others, is that on the whole, the tax cut was the wrong thing at the wrong time. Why was it the wrong thing? Well, good policy generally meets 3 tests. First is a growth test. It makes the economy stronger. Second is a fairness test. It makes the economy more fair. And third is a fiscal test. It's fiscally sustainable. TCJA does not pass any of those tests, and it clearly fails 2 of them. Let's start with the growth effect. That's the one that it does not pass. The Congressional Budget Office has indicated that national income after 10 years will go up by 0.1% because of the tax cut. That's a gross income number. If you looked at net income, it would actually be 0 or lower. So it clearly does not pass the growth test. Let's look at the fairness test. The tax cut increases disparities in after-tax income. It gives the largest absolute and relative tax cuts to high-income households. So that on that ground alone, it fails the fairness test. Let's look at the fairness test. But it's actually worse than that. Increases disparities. If you consider that the tax cut has to be financed in some way, it gives the largest absolute and relative tax cuts to high-income households. Issue. You consider that the tax cut has to be financed so that on that ground alone, it reasonable ways to finance the tax cut. But it's actually worse. You'll find that most households will actually be worse off. If you consider that the tax cut has to be financed in some way, than they would have been. You consider that the tax cut has to be financed some way. So it fails the fiscal test. You consider reasonable ways to finance. I'm sorry, it fails the fairness test. You'll find that most households will actually be worse off. And the tax cut clearly makes the government's already difficult long-term. So it fails the fiscal test even worse. I'm sorry, it fails the fairness test. I don't want to waste your time, and I don't want to insult anyone's intelligence, and the tax cut it's important to state the government's already not pay for long-term. It will not pay for itself. Even you can look at the analysis of any reputable organization. I don't want to waste your time, but it's important to state the tax cut did not pay for itself, including the tax foundation, and you'll find that that's the case. You can look at the analysis of any reputable organization, including the combination of not passing the growth test, including the tax foundation, failing the fairness test, and failing the fiscal test. So it fails the fiscal test that what the tax cut will actually do. The combination is give of not passing the growth to current generations of high-income households, failing the fairness test, and failing the fiscal test of low and middle-income households, will actually members of is give more money to future generations at the expense. At the very least, I think we can agree that is not a model for what members of public policy ought to do. Future generations. There are other issues as well. At the very least, I think we could agree that is not a model for what good public policy and increased uncertainty. It will reduce health insurance coverage. There are issues as well that make health insurance the wrong thing. It will likely reduce tax policy more complicated and increase uncertainty. Again, it will reduce health insurance coverage. These are not hallmarks of good. Raise the cost of health insurance. It will likely reduce those are the reasons why I think it was the wrong thing. Why was it at the wrong time? Well, it was enacted at a time when the economy was already going strong, So those are the reasons why I think it was the wrong thing. Why was it at the wrong time? Well, it was enacted at a time when the economy was already going strong. We had been expanding for 8 years. President Kennedy said the time to fix the roof is when the sun is shining. We had an opportune to deal with the fiscal situation, chance to address the fiscal situation while the economy was strong, when the sun is shining. Instead, we squandered that, making the deficit larger and giving tax cuts to address to high-income households. You should also be aware that the 2017 tax cut will make it harder for policymakers to making the deficit larger and giving reduces the ability of the tax system to high-income households. The effects of the recession. You should also be aware that the 2017 tax cut will make it harder for policymakers to fight future recessions. In terms of what you should do in response to these issues, I'll just touch on 3 issues. One is to fix function, the issues in TCJA. In terms of what you should do to give the IRS in response to these issues, to be able to do its job, I'll just touch on 3 issues. One is to fix longer-term revenue needs. Even if we do make judicious cuts in spending, the IRS, the laws of arithmetic dictate to be able to do its job, raise revenues. And a third is to value-added tax and longer-term revenue carbon tax. Even if we do make judicious cuts in spending, the laws of arithmetic dictate. I thank you very much for inviting value-added tax and particularly carbon tax. Thank you.
Thank you very much for your testimony. I just want to remind the panelists that all of your written statements have been submitted and received by the committee.
For inviting me, and I look forward to talking about all of these issues. Thank you.
Thank you very much for your testimony. I just want to remind the panelists that all of your written statements.
Chairman Yarmouth, Ranking Member Womack, and distinguished members of the committee.
You don't have to worry about that.
Thank you for the opportunity to testify today about how the 2017 tax law largely left behind and distinguished low and moderate income Americans. Thank you for the opportunity to testify today about how the 2017 since tax 1979 largely left real incomes of working class Americans. That is the racially and geographically diverse set of people. Since 1979, workers the real incomes of working class Americans virtually stagnant. That is the racially and geographically lowest income 60% of Americans saw their share of the nation's household income fall, while virtually stagnant. Those at the top saw their share gain by roughly the same amount. Of Americans saw their share of the nation's household income focused on helping those facing the steepest challenges in this economy gain by roughly the same amount. And here's a prime example. The 2017 tax law could have focused on helping those facing the steepest challenges from $1,000 to $2,000 per child. Them behind. But it denied that full increase to millions of children in low-income working maximum child tax credit. 11 million children in the lowest income working families, millions of children in low-income working families, or a token increase of just $1 million children in the lowest income working families. Another 15 million children got an increase of more than $75 of just $1 much less, but less, often much less than the another full 15 million children got an increase of more than $75. Another example is the law's failure to expand but less, often much less than the full $1,000 provision that encourages work, lifts the living standards of millions of working families, and helps children do better. Provision that encourages work, here are 6 ways that the living standards may in fact hurt many low and moderate millions of working families, and helps children do better. It puts workers' wages and workplace standards. And here are 6 ways that the law may in fact 20% deduction many low and moderate income households. That's an incentive for firms to buy workers' wages services without employing them directly through its hiring them as independent contractors or through another firm. An incentive and for firms to buy in some of these ways workers tend to be paid less than when workers are employed directly. Second, it retains and even creates new incentives in some of these ways and investments offshore than when risking workers' wages here in the US. Second, it retains and even creates new millions more people to shift profits or facing higher premiums because risking the Affordable Care Act here in the US requirement that most people enroll in health insurance. The law will leave millions more people uninsured or facing higher premiums. It erodes the value because of the Earned Income Tax Credit. The law uses a slower measure of inflation to adjust tax brackets and other provisions the value of the Earned Income Tax Credit. For working families, that means that the Earned Income Tax Credit grows more slowly over time. The law uses a slower measure of inflation and by 2027, tax brackets and other provisions that has 2 children earning $40,000, that means that the earned income tax credit grows more slowly over time by roughly $300. And by 2027, a family that has 2 children earning $40,000 credit will see 1 million children earned income tax credit overwhelmingly dreamers by roughly who are brought to the US by their immigrant parents. And tax credit for 1 million children $1.9 trillion overwhelmingly dreamers over 10 years who are brought to the US raises the pressure on policymakers down the road to squeeze or cut critical economic trillion programs and investments over 10 years have widely shared benefits. That raises the pressure on policymakers down the road in 2025 households in the bottom 60% critical economic security programs and investments with 1% of their after-tax incomes. But that pales in comparison to the top 1%'s tax cuts worth 3% of their much larger after-tax income, or about $60,000. But that pales in comparison on average to the top 1%'s tax cuts the tax worth 3% of their much larger inequalities incomes. Decades of policy choices have set up barriers for households of colour, so they are overrepresented. That skew of the tax law increases racial inequalities. Decades of policy choices have set up barriers for households of colour. That white households in the top 1% at the bottom of the income distribution worth more than the tax cuts for the bottom 60% of households of all races combined. In the top 1% and Prosperity Now cuts worth more. Other winners are the tax advisors and lobbyists who are calling this law of all races combined. ITEP and Prosperity Now policymakers can set a new course and pursue other winners true tax advisors and lobbyists prioritizes calling this law with low or modest incomes. Raises revenue to meet national policymakers can set a new course and pursue true tax reform. Thank you, and I look forward to prioritizes people.
Thank you very much for your testimony. I now recognize Ms. Bruckner for 5 minutes.
Thank you for inviting me, and by extension, the American University students who are here with us today. Today, I want to share with you.
Thank you very much for your testimony. I now recognize Ms. Bruckner for 5 minutes.
How some of the business. Thank you for inviting me, and by extension, the American University students who are here with us today. Today, I want to share with you how my research indicates the need for small businesses that have been impacted by tax reform, and lastly, the need to consider the budget implications of tax reforms, failure to address the tax compliance challenges of the gig economy. First, this committee needs to develop a comprehensive strategy to study and give oversight to business tax expenditures to consider their impact and effectiveness with respect to women business owners. This research matters because 40% of U.S. businesses are women business owners, yet they remain primarily small businesses operating as service firms and continue to have challenges growing their receipts and accessing capital. Notably, women of color are the driving force behind the growth of women-owned firms. And while we do have good news on their growth in numbers, women business owners still struggle to access capital to grow and scale their businesses. At the same time, tax plays a key role in the survival and growth of small businesses, primarily through its effect on equity infusion. However, to date, there's been no formal government or congressional study on how the U.S. tax code's more than $333 billion of expenditures targeted to small businesses impact women-owned firms. This is troubling considering in 2017, I published groundbreaking research that found that Congress has a $1 billion blind spot when it comes to understanding how business expenditures help these firms. In fact, the 3 of the 4 small business expenditures I studied either explicitly excluded service firms and by extension the majority of women-owned firms, or effectively bypassed women-owned firms who are not incorporated or who are service firms with few capital-intensive equipment investments altogether. Congress doubled down on this $1 billion blind spot during tax reform when it made additional multi-billion-dollar investments in tax expenditures that our research suggests are less favorable to women business owners. For example, JCT's analysis of the new Section 199 Cap-A deduction for individuals with business income shows that the majority, 90% of the revenue distribution loss will flow to firms who have incomes greater than $100,000 of revenue. 88% of women business owners have revenues below $100,000. This inequitable distribution of the revenue loss is even greater and more stark at the higher income levels. Only 1.7% of women business owners have revenues over $1 million, yet 44% of the revenue loss flows to those firms in this year alone. A second concerning aspect of tax reform is its impact on healthcare costs for the small business owners, those self-employed workers who buy insurance on the private markets. However, as part of tax reform, Congress effectively repealed the individual mandate, which CBO estimated would result in 4 million fewer people carrying insurance this year, another 13 million in 2027, and that 10%, that premiums would increase by 10% in most years of the next decade. Recent evidence shows that CBO was correct. In fact, 2019 premiums, according to at least one estimate, will be an average 6% higher as a direct result of the individual mandate repeal and the expansion of more loosely regulated plans than would otherwise be the case. And it's not just an increase in premiums that are a cause of concern with respect to the impact of tax reform. The reported lower refunds taxpayers are receiving due to changes in withholding may have unintended yet painful consequences for taxpayers who anticipated a higher refund and put off healthcare spending until they got their refund. Banking research shows that Americans increase their out-of-pocket healthcare spending by 60% in the week after receiving a tax refund. For those taxpayers who this year are receiving lower refunds, they may have to wait even longer to pay for much-needed healthcare costs. Finally, I'm really concerned about how tax reform failed to address the tax compliance challenges of the 2.3 million Americans working in a side hustle in the gig economy. In 2016, I published research that shows that more than 60% of these workers don't get any tax information reporting forms, which means the IRS doesn't either. Under current law, the platforms are not required to publish these forms to the workers or the IRS until those until those workers meet a $20,000 200 transaction threshold. But the reality is most folks with a side hustle in the gig economy never meet that $20,000 threshold and therefore aren't getting the tax information reporting forms that they need to actually pay their taxes. This has dire consequences with respect to the budget as well as their ability to fund their own Social Security contributions. However, Congress was well aware of this issue and chose not to act in connection with tax reform. These are issues that Congress and this committee should be tracking and studying as it moves forward with its oversight of tax reform. Thanks so much, and I'm happy to answer any questions that you have.
Thank you very much. I now recognize Ms. Paul for 5 minutes.
Good morning, Chairman Sorry. Good morning, Chairman Marruth, Ranking Member Womack, and members of the House Budget Committee. My name is Lana Paul. I'm an owner of multiple small businesses in and around Pella and Des Moines, Iowa. I serve as the president of Giddings Incorporated, GI Warehouse Corporation, Mobility Sales and Service, and Creative Inspirations. Thank you for inviting me today to testify. Giddings Incorporated was founded in 1972 by my father, Delroy Wayne Giddings. Dad completed only a 6th grade education, but his drive and motivation made him a successful entrepreneur. His many businesses included a landfill, a filling station, a pool hall, a car dealership, and an excavating company. 47 years later, the company continues to operate using Dad's motto for life, if it's worth doing right. In 1975, Giddings expanded to the nearby town of Knoxville with the building of a warehouse and the founding of GI Warehouse Corporation. Additional warehouses were built to fulfill demand. Giddings Incorporated and GI Warehouse Corporation continue to operate based on Dad's original values of integrity, honesty, respect, and loyalty, and are committed to delivering quality service, one customer at a time. I joined the company on a full-time basis in 1975. I bought out my retiring brothers in 2011 and 2012 and became the sole owner of Giddings Incorporated and GI Warehouse Corporation. In 2015, I carried on my father Wayne's tradition of entrepreneurship and opened 2 new small businesses along with the next generation, my children. Mobility Sales and Service is an outdoor power equipment retailer and service provider in Pella and Des Moines. Mobility recently purchased Odyssey Spas and moved into selling new products like spas, swimming pools, and hot tubs. Creative Inspirations is a promotional product distributor specializing in apparel and customer fulfillment, also in Pella. Both of these businesses are rapidly expanding. I hope to pass the businesses on to the 3rd and 4th generations of our family. The 2017 Tax Cuts and Jobs Act provided tax relief that allowed us to invest in our employees with raises and invest in our businesses with a significant facility expansion and new vehicles. The new tax law also increased local and national business confidence. Together, these factors continue to benefit our local and national economies. 2 of the most significant direct benefits from the new tax law for our businesses were the creation of the new small business deduction, Section 199A, and the expansion of the small business expansion at Section 179. For tax filing purposes, our businesses are organized as S corporations and LLCs, meaning the business earnings flow through to my individual tax return. The vast majority of small businesses are organized similarly. The creation of the new small business deduction provides substantial tax relief for businesses like ours, with a deduction up to 20% from business income. My accountant informed me that the new small business deduction will provide around $40,000 in tax relief for our businesses. This tax relief provides crucial cash flow that allowed us to provide up to $4,000 raises to our employees, the largest raises we have been able to provide in recent years. These raises increased employees' take-home pay and helped us retain employees. As you know, businesses across the country are experiencing tight labor markets, an indicator of a strong economy. The labor market is especially tight in Iowa. Retaining high-valued employees is key for our business to function. Additionally, we invested $2 million in nearly 40,000 square foot expansion of GI Warehouse Corporation, which was completed in December. We are now up to 460,000 square feet in warehouse space. We have filled the warehouse space, another strong economic sign. The new tax law doubled the small business expensing thresholds of the tax code from $500,000 in 2017 to over $1 million in 2018. This expansion incentivized us to purchase 6 new semi-trucks totaling $1 million and will allow us to immediately expense the cost of the trucks in 2018 instead of depreciating that amount over several years. I observed other small businesses in and around Pella also investing in employees and companies. Multiplying our experience by millions of small businesses around the country demonstrates a significant economic benefits resulting from the Tax Cuts and Jobs Act. Many of the provisions benefiting individuals and small businesses, like the small business deduction, sunset after 2025. That sunset date makes small business owners nervous about future expansion. To provide long-term certainty and confidence for small businesses, Congress should make these provisions permanent. I urge Congress to pass the bills like the Main Street Tax Certainty Act. Thank you for the opportunity to testify. I look forward to answering any questions.
I thank you all for your testimony. We will now begin the question and answer part of the hearing, and as is our habit, the ranking member and I will defer our questions to the end, so I now recognize Mr. Higgins of New York for 5 minutes.
Thank you, Mr. Chairman. Firstly, just, Dr. Gale, you had talked about 3 criteria as it relates to testing growth, fairness in a fiscal test, all of which this tax cut failed. Is there any tax cut that actually pays for itself?
There certainly are situations where reducing a tax rate could pay for itself. For example, if you had a 95% tax rate on some form of income, you reduced it to 90%, you would likely end up raising revenues because you're doubling the after-tax return there from 5 to 10 cents on the dollar. But none of that really applies. I mean, we're way over on the other side of the so-called Laffer curve.
Mark Zandi from Moody's Analytics, a former advisor to John McCain, had said that the best case scenario for a corporate tax cut is a return of 32 cents for every dollar that you give away in a tax cut, corporate tax cut. So that would say to me that your return on investment from that tax cut is minus 68%. Is it a fair characterization?
We'll clearly get some revenue offset from corporate tax cuts. There'll be some, we won't lose 100%, but it really depends on what part of the corporate tax system is cut. Cutting the rate, which is what happened in 2017, is the least efficient way to generate new investment, because a huge amount of current corporate investment is income from investment in the past. And so cutting the rate doesn't do anything to boost investment in the past. You get a much bigger bang for the buck if you give incentives to new investment. So for example, if we raise the corporate rate to 25 or 28, but also moved all the way to expensing, we would get more investment and more revenues than the current system.
When this corporate tax bill was originally made public as a proposal, the White House Council of Economic Advisors had stated in a formal communication to the House Ways and Means Committee that this proposed tax cut would increase household income by between $4,000 and $9,000, and this would be recurring. This would happen on an annualized basis. I don't have any evidence that materialized. Is there any evidence that there's been an increase in household income to the extent to which the White House Council of Economic Advisors had stated that it would?
Well, the CEA was very careful not to specify a date by which that would happen. So it's, I don't think anyone expected to happen in the first year, but they expect income to rise by $4,000 to $9,000 above what it otherwise would have risen. I find that extremely unlikely, and I'll refer back to the CBO numbers I mentioned earlier, that after 10 years, national income will only go up by 0.1%.
How could, who's the Council of Economic Advisors?
The White House group of economists.
And that would include perhaps the Treasury Secretary?
No, no, sir. The CEA is a set of staff members. There's 3 members of the council. Kevin Hassett being the head of the council right now, and I think there's about 15 or 20 staff members that they work for the White House.
Okay, how could they be so far off?
Their document cites the literature in a number of ways, but I and others, when we look at the literature, reach different conclusions than the CEA does.
Who is the author of the literature?
There are numerous articles.
Okay, so they're economists. They're looking for literature, presumably, from other economists. So I'm just kind of curious as to what the Council of Economic Advisors, who would they defer to in order to inform them of a decision that they have to make a formal report on the White House Council of Economic Advisors stationery to Congress?
Normally, they would look at the academic literature, but it's not always easy to interpret these numbers. For example, there was a study in Germany that half of the corporate tax is passed on to workers, and people try to use that in the United States, but it's not a valid comparison because the governmental units in Germany are much smaller than the overall size of the U.S. economy, so the amount of shifting of the tax will be different.
I know my time's expired, but let me just say this. So, the White House Council of Economic Advisors, who make a report to Congress, may have made reference to the literature on economics that was established by economists in Germany?
So they cite a lot of the literature. My point is, I think that I and others who've looked at the same literature would reach different conclusions from it.
I yield back, thank you.
Gentleman's time has expired. I now recognize Mr. Flores from Texas for 5 minutes.
Thank you, Mr. Chairman. I appreciate the panel for joining us today. Some of the testimony today, I think, has been somewhat inflammatory and a little bit reckless, particularly economically reckless. I'd note that on the panel, there's really only one person there who, like me, has signed the front side of a paycheck, and I would submit that that gives us a much better understanding of the real-world economy versus the understanding that may come from looking at a model. I've got a couple of examples of the tax impact. I just exchanged text messages with a person who owns Black Hawk Arrow in Waco, Texas. He describes this as a mom and pop business that is celebrating its 20th anniversary this year that has gone from $0 to $90 million in revenues during that 20-year process. Here's what he says. He says the tax cuts can be directly attributable to our significant increase in business.
Buyers are able to take advantage of the 100% depreciation on our products that we sell, so the sales uptick increased dramatically by about 40%. And then I'm going to go on and say we've been able to raise pay, we've been able to invest in new facilities, we've been able to grow our employee base, and all of that made 2018 a record year, and what they believe 2019 will be equally as good moving forward. So then I go to another part of my district down in Bryan College Station, Texas, and there's a business there called Village Foods and Pharmacies, and it says to highlight the direct results of the Tax Cuts and Jobs Act. The owner has said that that they have been able to put together bonuses and a brand new 401k program for all employees. And this is just like these stories you hear all over the country. This is the real world. This isn't something where we're trying to move forward. Trying to reflect some sort of the inflammatory rhetoric that we heard before. One of the things that I think is interesting is that talk about a carbon tax. A carbon tax would hit the families, as some of these witnesses talked about, as having been impacted adversely by the Jobs Act, even though they have more pay than they had before and more job opportunities than they had before. It's been said a carbon tax would hurt them the worst. Their cost of living would go up dramatically under a carbon tax regime. And with the somewhat promise that they'd get some of it back from Washington, we've seen Washington break too many promises. We've heard claims that the Tax Act has has increased the deficit, but as a person in the real world, when my revenues go up, then I am better off. And the country's revenues, the federal government's revenues have gone up from 2017 to a record in 2018. And they're on track to go up again for another record terms of receipts by the federal government in 2019. It's hard for me to see how that increases the deficit. Now, what does increase the deficit is spending. And this goes back to what the GOP leader said a minute ago, and that we don't have a revenue problem, we have a spending problem. And so we need to look at ways to address the spending. What we've heard from the other side of the aisle are huge programs they want to roll out. Like the Green New Deal, which we got a cost estimate on it the other day of $93 trillion, which would represent about 90% of the wealth of every family of all the families in this country. Ms. Gale, I have a question for you, if you don't mind. Excuse me, Ms. Paul, I have a question for you. Since again, you operate in the real world, not in an academic world. And you have an understanding what it means, the challenges it means when you hire somebody, you sign the front side of their paycheck every few days. Can you talk about the impact of some of the tax proposals you heard from the other witnesses in their testimony?
One of the things that was talked about that really stuck out to me was the health care. That cost health care to go up. My experience has been in the last 5 years, we've had health care increases of 17%, 19%, 29%, and again this year now to 9%. So I don't think that this law had anything to do with this. This was prior to that, and that was through Obamacare when everything started skyrocketing on us. So that's one of the reasons that we were having a hard time. We have, since 1975, paid 100% of our employees' health care costs, family and all. They have no cost out of pockets. And it did not allow us to give any raises. And so that's why this was significant for us to have the raises this year.
Okay. Thank you. I yield back the balance of my time.
Thank you, gentlemen. I now recognize Mr. Scott of Virginia for 5 minutes. Oh, Mr. Doggett's back. Mr. Doggett of Texas for 5 minutes. Sorry.
Thank you very much, Mr. Chairman. In many ways, perhaps the best label for this tax law is the whopper, and there have just been one whopper after another about it. I think Mr. Higgins just referred to one of the most significant ones, the claim that Americans would receive on average $4,000 in additional household income every year. We now know that not only do Americans have good reason to be asking, where's my $4,000? Or as Secretary Mnuchin put it, it'd be $4,500 that we'd be getting. because in fact, the estimates I've seen is that over 95% of American workers have not received any bonuses or any wage hikes due to this Republican tax law. So while there may have been a sugar high for the economy in the short term, we know immense debt is coming our way, and the $4,000 is just still not available for most Americans. But that's not the only whopper. And Ms. Wong, I would like to discuss with you the portion of your testimony that focused on the international side, because certainly among those who received the greatest rewards were multinational corporations. In fact, they got a bonanza out of this. Now, President Trump, on one of his many tours to the golf course, apparently told executives that we could expect $4 trillion that would just come pouring back when they gave this discounted rate on these so-called repatriated earnings abroad. How near have they come to the $4 trillion of repatriated earnings coming back to invest and create jobs here in America?
So I think nobody's been able to figure out where that $4 trillion came from. And
well, it's like a lot of his numbers.
To date, we've seen about $500 billion in repatriated earnings. And we've also seen very little of that flow through into increased investment or wages.
Right, because as we expressed concern when that tax law was being written, in fact, what happened the last time they had a repatriation, the same thing happened again, and that is the money flowed into stock buybacks and to dividends. So if you were one of the American families who had stocks in one of these companies, you maybe did well, but very small portion had that. Is it correct that almost all of the money that has come back has gone into stock buybacks and dividends and some increase in executive pay?
And that's absolutely not surprising, as you said. I think we mentioned earlier CEA Chair Kevin Hassett. Before this bill was enacted, another one of his promises was the suggestion that a lot of that money would flow through directly into investments in factories and jobs in the US, combined with the cut in the corporate rate. If you notice his language since the bill was enacted, he's kind of changed his story since then and saying now, oh, well, it's kind of expected that you would get this one-time sort of glut of buybacks and dividends and so on and so forth. So the ultimate increase in wages for workers seems to be getting further and further away in terms of what we're being promised.
And then another one of the whoppers that was told was that there were things in this tax bill that were going to prevent the outsourcing of American jobs. In fact, aren't there a number of provisions that have been added by Republicans in this tax law, such as the fact that you might pay nothing or no more than half of what you'd pay here in America in taxes if you invest in Shanghai instead of investing in San Antonio?
That's absolutely right. The basic structure of the law is that there's a permanently low discounted rate on foreign profits as opposed to profits earned in the US. And the law, in a way, recognises that problem, and it has a whole series of guardrails to try and stop shifting of profits and investment offshore. But one of these very measures creates its own new incentive to actually shift investment offshore.
As I think you know, I have outsourcing legislation to try to close all those loopholes. Is it important to protect American jobs by closing these giant loopholes that Republicans created in their tax law to encourage the outsourcing of jobs and investment from our country to abroad?
It's vitally important, and also important to protect that revenue that could be put to better use investing in infrastructure and other shared priorities that would help the economy at home.
Thanks to all of you. I yield back.
Gentleman's time has expired. I now recognize Mr. Johnson of Ohio for 5 minutes.
Thank you, Mr. Chairman. I want to thank our witnesses for being with us today to have this very, very important discussion. You know, in my, especially you, Mrs. Pohl, for providing a voice of reason for small businesses. That's so vitally important here. Small businesses create roughly 60% of the jobs in America, and without what you and others like you do, our economy falters in a very, very big way, so thanks for being here. You know, in my part of Ohio, small businesses like yours, one, for example, Bully Tools in Steubenville, are staples of the economy and employ their neighbors in good-paying jobs. Bully Tools manufactures equipment for gardening, roofing, and other work, and is in the planning stages of opening a second factory due to the tax reforms that were passed last session, the Tax Cuts and Jobs Act. They were also featured at President Trump's Made in America showcase in the summer of 2017 as the business representative from Ohio. The people I represent in eastern and southeastern Ohio are, by and large, hardworking members of the middle class, but contrary to the rhetoric on the other side, they have seen real benefits from the Tax Cuts and Jobs Act. There have been some clear benefits for small businesses like Bully Tools, such as increasing the thresholds for the estate tax and the alternative minimum tax. And for the 85% of families in my district who take the standard deduction, more of their money is tax-free because the Tax Cuts and Jobs Act nearly doubles the standard deduction for married couples and individual filers. With more money at home, families can support our small businesses. So, Mrs. Paul, have you seen this type of indirect benefit of tax reform in your community and businesses like yours?
Yes, we've seen our town really growing, and we've seen new businesses coming in. We have two large corporations, Pelcorp and Vermeers, that supply a lot of our small businesses with work, and that's one of the reasons I'm able to build a warehouse. So with this coming through, even though some of it's going to the large corporations, they're turning it around and also allowing small businesses to gain from it, which allows employees to gain.
Okay, well, thank you. You know, one of the most often repeated criticisms of the Tax Cuts and Jobs Act is that they are supposedly driving our country off a physical cliff. The reality is that even with the tax cuts, the federal government is projected to bring in a staggering $46 trillion in revenue over 10 years. No nation in the world has ever collected more. The federal government clearly has a spending problem, not a revenue problem, and it's the out-of-control mandatory spending that's the driver of our deficits. What I find disconcerting is twofold. My Democrat colleagues have proposed to dramatically increase mandatory spending with a new spending wish list costing over $50 trillion over the next decade. And second, they want to pay for their new priorities by increasing taxes on Americans. I'm assuming this would include rolling back the tax relief that the Tax Cuts and Jobs Act brought for all Americans. I would refer my colleagues in the majority to an article that came out in Roll Call just today. There are some examples. Look at the big blue states, states like New York, California, Illinois, that are struggling to make ends meet. They've got rising deficits. Look at states, on the other hand, by the way, those states have really high tax rates. Look at states like Texas and Florida and other states who have understood that there is a phenomenon that occurs when you allow the American people to keep more of the money that they earn. Now, it doesn't match up with the static scoring of CBO and others here in Washington, where we play funny money deals. But I can tell you that the American people know real money when it's in their pocket. So, Dr. Gale, do you think it would be plausible to increase taxes to fully pay for the spending wish list? And if so, what kind of tax increases would you suggest to pay for this $50 trillion of new spending?
The CBO estimates of TCJA that show that TCJA loses substantial amounts of revenue are not static estimates. They're fully dynamic.
That's not what the question I asked you. I asked you what kind of tax increase do you think it would take to pay for this $50 trillion wish list?
I think there's a number of tax increases. We should pursue the carbon tax with offsets for low-income households is clearly one of them. The value-added tax with offsets for low-income households is clearly another. How we get all the way to the number you specified is a different question. But
that's not a number I specified. That's their wish list. That's the Democrat wish list of $50 trillion. So
how we get to the number you asked me about is a different question. I think that even if we do generate judicious spending cuts in Social Security and Medicare, if you look at the arithmetic of the budget outlook, we will need to raise tax revenues.
When please note, Mr. Chairman, I must qualify. I never said cut Social Security and Medicare. I want to make sure those were your words. That's not where I'm suggesting that we cut.
Okay, gentleman's time has expired. Now recognize Mr. Scott of Virginia for 5 minutes.
Thank you, Mr. Chairman. You're going to have the charts come up. Mr. Chairman, the ranking member has frequently asked us what our plan is. And I just put this chart up here to show that during Republican administrations, the deficit gets worse. During Democratic administrations, the deficit gets better. We had pay-go, where if you have a wish list, you have to pay for it. And therefore, as opposed to tax cuts that are not paid for and put us in the ditch. So in response to the question, our plan is the blue, their plan is the red. And in terms of jobs, next chart. In terms of jobs, you can see where jobs have gotten better. In about 1990, there was a bipartisan bill where President Bush, I guess we misread his lips, and jobs got better. During the Clinton administration, they got better. You can see it in 2009, at the bottom of 2009, President Obama had an economic plan. We passed a $1.5 trillion economic plan, and you can't point to where on that chart it even made any difference. And so in terms of what our plan is, if we could get back to Democratic administrations, we'd have a much better budget. Dr. Gale, let me ask you a question on tax cuts generally. Some tax cuts stimulate the economy, some don't. Which tax cuts tend to stimulate the economy?
You'll get the biggest bang for the buck for tax cuts that get spent rather than saved. And that typically, in terms of households, that's typically money that goes to lower and middle income households who tend to spend a greater share of their income than high income households who tend to save more.
And so this tax cut, where 80% of the benefits went to the top 1% in corporations, would miss that mark.
This tax cut was not well designed to boost short-term consumption, right?
And how did the tax cut miss, we heard how they missed women businesses. How did they miss small businesses?
The small business literature issue is confusing. It's actually young businesses that create most of the jobs. Most of the small business sector is sort of sleepy and quiet. And just as you wouldn't want to confuse small people and young people, you don't want to confuse small businesses and young businesses. So what's important is that we generate incentives for young businesses to grow. But if we subsidize all small businesses, we're spending a lot of money without getting a lot of bang for the buck in terms of the economics.
Mrs. Hung, you talked about how the pass-through deduction hurts individual workers. Can you elaborate on that a little bit?
The problem is that it actually might encourage companies to replace good jobs with independent contractors or to outsource those jobs to outside contractors. So my colleague Brendan Duke has research that shows that it risks pushing more workers into low-wage firms or outside the protection of labour laws. So many companies already outsource their janitorial staff, their security guard jobs to outside contractors, for example, but the pass-through deduction gives them a tax incentive to do even more of that. So if you were to take a company that was considering whether to retain its in-house IT department or to contract to an outside firm to do that same work, if they contracted to the outside worker, that would get the benefit of the pass-through deduction that they could then split. So that's a tax incentive to go in that direction. Now, that's not really encouraging entrepreneurship or job creation, it's just splitting firms up.
What's wrong with, why is the worker at a disadvantage as an independent contractor?
Well, in the independent contracting case, there's a lot of research that shows that pay and benefits and legal protections for independent contractors go down. So even though you might get a little bit of pass-through deduction, you could be giving up a whole lot in terms of health benefits, workplace protections, and other benefits that usually come on top of wages.
And Ms. Bruckner, could you say a word about how we missed small businesses with the tax cuts?
I think that we didn't do careful thinking about what type of small businesses we're going to invest in. Women business owners start businesses at rates faster than 5 times the national average, and yet we've never considered if small business tax expenditures generally specifically target and help those women business owners grow. And we don't know if the money that we're investing in these business expenditures at all helps these businesses start and grow. And in fact, my research shows that it bypasses the majority of women business owners who are very small and in services altogether. So in essence, it could very well be that you're subsidizing the same firms over and over again, as opposed to investing where there's actually opportunity for economic growth. The absence of congressional research and study on these issues means that you guys are operating completely blind.
Gentleman's time has expired. I now recognize Mr. Hearn of Oklahoma for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Womack. You know, as a small business owner for the last 34 years, I find it very interesting to listen to the testimony of those who actually paid the taxes and those who talk about the tax policy. It's pretty fascinating. I'd like to ask each one of you, I know Ms. Paul's created jobs. Have any of the three of you ever actually had to use the tax code and whichever tax code to actually create jobs, have employees, and be responsible and be the last to get paid?
Well, I'm someone that is actively looking for opportunities to start my own small business, but my concern over healthcare costs is precluding me and my husband from starting our own small business. It's something that we're actively concerned about and has delayed. Like most of the literature shows that when you're disproportionately concerned about stability for healthcare, it delays entrepreneurship.
Perfect. You should have been around about 8 years ago. Yes, ma'am. Ms. Hong?
I have not employed people.
Okay.
But I also would like to say that also in the real world are the millions of workers who receive the paychecks. And I think their voices, including the 11 million kids that get $75 or less from this bill, is also important when thinking about the impacts on the real economy.
Sure, absolutely. Mr. Gale?
I've run a small consulting business and have had people work for me. They were not employees, they were contractors.
Fair enough. I thank you, Ms. Paul, for all the work you do and being the last to get paid, because anything that happens to expense your business does affect what you take home. And you make sure, as you said, that your employees get paid first and that all your vendors get paid. And that's no easy task as a small business owner. You know, your story is fantastic, and, you know, fortunately it's not unique across the country, as many of my colleagues have brought up. Many of my families in Oklahoma's 1st District benefit from the Tax Cut and Jobs Acts as well. Today, I'd like to highlight 22,000 of those people in my district. Constituent of mine, Norm S. Bjornson, is the founder of Aon, a Tulsa-based company whose engineers, manufactures, markets, and sells air conditioning and heating equipment. Norm employs approximately 2,000 individuals at his Oklahoma and Texas facilities. Norm announced personnel employed by Aon on January 1st, 2018, excluding executives, will receive a $1,000 bonus in recognition of the new tax form law. Additionally, headquartered in Tulsa, a Quick Trip convenience store employs over 20,000 people, started in Oklahoma, in Tulsa in 1961. Fortune has ranked Quick Trip as on the list of best companies to work for 14 years running. Quick Trip also gave their employees bonuses, including part-time employees and excluding those who are considered executives. Quick Trip also credits the ability to provide these bonuses to the Tax Cut and Jobs Act. The bonuses range from $500 to $3,000 per employee. Additionally, they're using savings to grow their company and provide opportunities for their employees. Finally, as a direct result of the Tax Cuts and Jobs Act, Cox Communication added roughly $450 million additional dollars into their employee pension investments to bring solvency to their plan. You know, I would like to say that as a direct result of the Tax Cut and Jobs Act, family in my district ended up with more money in their pockets this year. Small businesses like my own invested over $2 million last year because of the benefits that were brought forth. In addition to the bonuses, added benefits and pay raises, the average family in my district received a tax cut of around $1,888. And to me, this sounds remarkably better than proposed Green New Deal, which would cost each American family as much as $650,000 per household. We can range from $50 trillion to $93 trillion, whichever number you want to pick. And I also find it very interesting that all of a sudden that our colleagues and the witnesses are talking more about debt after we started putting taxpayer dollars back into people's pockets. And no one is talking about Democrat proposals coming from this Congress alone, which will cost upwards of $100 trillion. And why aren't we holding hearings talking about that instead of how we're going to spend more? I yield back my time.
The gentleman's time has expired, and now recognize Mr. Peters of California for 5 minutes.
Thank you, Mr. Chairman. We missed a real big opportunity to do real tax reform. Real tax reform would have promoted American growth and competitiveness. Instead, Republicans chose a path that blows up the deficit and will harm working families in the long run. And I was at the microphone protesting this move at that time, as were many Democrats, because debt matters. Debt crowds out private investment. Debt gives us less flexibility to respond to emergencies. Debt increases the risk of financial crisis, and I sincerely hope my colleagues on both sides of the aisle will examine the long-term consequences of ignoring the debt and how this tax bill contributed to this debt crisis. Mr. Gale, I wanted to ask you, how much did the 2017 tax law increase debt and deficits?
Under CBO's dynamic estimates, the full increase in the deficit would be about $1.9 trillion over 10 years. That's for the tax cut as it's written. If the temporary provisions were extended, the net deficit effect would be over 3.1 trillion.
Right. And someone suggested that these were static analyses. Can you describe briefly what you mean by dynamic in that context?
Sure. What's called a static analysis incorporates a lot of behavioral responses, but it keeps the macroeconomic aggregates constant. So it keeps output constant, but it allows people to shift, for example, between different types of saving if it were a proposal to increase IRAs or something like that. A dynamic estimate is also called a macro feedback estimate. It includes the impact on the economy as well as then how that feeds back into revenues, as one of the congressmen was discussing. So it incorporates all of those effects.
It's fair to say it's more comprehensive view to do dynamic than static.
Yes, absolutely.
Even after the law passed, and independent groups scored it as increasing the deficit by nearly $2 trillion, the administration claimed that it would pay for itself. Secretary Mnuchin claimed, quote, "So we're humming along on where projections are, and as I've said, at 3% economic growth, this tax plan will not only pay for itself, but in fact create additional revenue for the government." Mr. Gale, is there any evidence to support this claim?
No. There is, in principle, a growth rate at which the tax cut would be revenue neutral, but no one from the CBO to the JCT to Mark Zandi, who was mentioned earlier, to the Tax Policy Center, to others, nobody predicts that the economy will grow at that rate.
If I recall, it was something around over 4% was the assumed rate at best case.
I believe that's right.
And again, as you said, CBO shows that the tax bill, even if some provisions expire on schedule, will add $1.9 trillion to the debt by 2028. And that extending it this year would cost at least another $1.1 trillion through 2029. Some people like to take a shot at my home state of California and their relatively high tax rates. I would just say that growth in California has been pretty strong. And do you agree with that understanding?
Yes, the economics literature is pretty clear on this. There's a very weak relationship between state growth rates and state tax rates.
Right. I'd also note that in Kansas, where there is a huge effort to cut taxes, as unprincipled as this effort in Congress in 2017, voters wised up and removed the governor because they wanted to see public investment. And public investment now is at a relatively low historical level for the United States of America. And if we wanted to encourage economic growth, and I hope we will discuss that in this committee, that would be something we would want to consider to invest in. Finally, Mr. Gale, is there, when you give tax cuts, when you essentially debt finance tax cuts like we did in 2017, is it fair to say that the growth impacts are less than debt financing something like infrastructure?
I think in general, yes. It depends on how the tax cut gets used. But if a significant percent of it gets used simply to be spent, whereas if 100% of the infrastructure gets focused on new investment, then the infrastructure investment will have a bigger impact.
Well, on trade and on things like the deficit, I invite the Republicans back to the roots and hope we'll have that discussion.
Gentleman's time has expired. I now recognize Mr. Smith of Missouri for 5 minutes.
Thank you, Mr. Chairman. I appreciate the opportunity to have this hearing for us to highlight the benefits of the Tax Cut and Jobs Act. I'm reminded of a gentleman from my home state, Mark Twain. Mark Twain had a quote that said, "You can't depend on your eyes when your imagination is out of focus." That's what I'm reminded by so much of the conversation that I've heard sitting on this panel today. As one of the original co-sponsors and writers of the Tax Cut and Jobs Act, there's a lot of not serious conversation when we're talking, first off, about the statement of a $1.5 trillion debt over 10 years or a $1.9 trillion of debt over 10 years to pay for the Tax Cut and Jobs Act, whenever more than half of my colleagues on the other side of the aisle has signed on to House Resolution 109, the Green New Deal, which reports showed yesterday would cost $94 trillion. $94 trillion. That's $9.4 trillion a year. And you all are saying that we're exploding the debt over $150 billion that we allow American taxpayers to keep of their money, not the government's money, of their money. So my question is, to the other side, actually, is when you're proposing 12 Democrat colleagues of mine on that side of the aisle have co-sponsored the Green New Deal, who wants to add $94 trillion. This is what we're dealing with on the Budget Committee, people that are not being realistic. What I will say is I represent one of the poorest congressional districts in Congress, maybe the poorest on this committee. The median household income in my district is $40,000 a year of a family of four. Southeast Missouri. And I can tell you that, Mr. Gell, your judgment when you say that you look at things of whether it's the wrong thing at the wrong time in your opening statement, well, I will tell you the young lady who got a very nice sizable bonus at Lowe's in Rolla, Missouri, when I met with her because of the Tax Cut and Jobs Act, she was able to purchase a new car seat for her toddler because her old car seat was broken. That was at the right time. It was not at the wrong time, and it was for the right person. I can talk to you about the bank teller in Hartville, Missouri, who told me that U.S. Bank, because of the Tax Cut and Jobs Act, is now paying all their employees at least the starting wage of $15 an hour. That's real money in Wright County, Missouri. I can tell you about the individuals at the call center in Cape Girardeau, Missouri that received a $1,000 bonus from AT&T because of the pass-through of the Tax Cut and Jobs Act and the savings that they were able to pay for their kids' college books. That is real money. $850 in Southeast Missouri is not crumbs. To some politicians in San Francisco, California, it's crumbs. But where they make their median income household of $40,000 a year, that's a couple months' rent. That's a couple car payments. So unless you've been to the Boot Hill of Missouri and you see what my people are experiencing, don't you say that the people of Southeast Missouri have not benefited. We see a growing economy. Right now, we have the largest increase in wages in over a decade. CBO said that. CBO predicted more than 900,000 new jobs over the next 10 years. These are facts. Mrs. Paul, thank you for being here. And I also want to thank you, the very last line in your statement, you encouraged Congress to pass the Main Street Tax Certainty Act. I'm with you. That's my legislation. So thank you for highlighting that. And that causes real growth for small businesses. And Ms. Brunkner, I hope that you have the opportunity to open up your small business. And I don't know why you weren't able to do it after the Democrats passed Obamacare, because we've not changed health care from when they did until last year. And when you look at the CBO report, they predicted that by eliminating the mandate, it would take 14 million people off, but CMS just reported that it's 2.5 million people that chose not to purchase health care because they could find it cheaper somewhere else. With that, Mr. Chairman, I yield back.
Gentleman's time has expired. I now recognize Mr. Horsford of Nevada for 5 minutes.
Thank you, Mr. Chairman. And first, I'd like to start by saying being an advocate of small business is not a partisan issue. Coming from my district, Nevada's 4th district, I work very closely with my small business community, the Metro Chamber, the Urban Chamber, the Latin Chamber of Commerce, the Asian Chamber. I myself am a small business owner and have helped to create jobs. And so to suggest somehow that this is a partisan issue, I just don't ascribe to that thinking. But what is a real fact is that the tax scheme that was passed by the prior Congress gave a temporary tax benefit to small business, but gave a permanent tax break to big corporations. So while we have these slides today showcasing a number of small businesses by my colleagues in their district, which we fully support, I guess the question would be, why wasn't there advocacy for them to make their tax break permanent instead of temporary? My question is related to the facts and not fake news, is since last year, corporate profits have increased by 13% from already near record high levels. So why did we give permanent tax cuts to big corporations and not help more small businesses so that you could predictably plan for the future, hire more people? Why did they approve a tax plan with no public hearings in 51 days and not take into account the fact that, again, according to the recent data available, wages are essentially flat since the passage of this tax bill? So, Ms. Wong? Thank you. The tax law delivered the largest tax breaks for the wealthiest households, specifically corporations. Many analysts predicted that because most of the benefits flowed to the richest taxpayers, economic inequality would increase. Can you briefly elaborate on how the tax law worsens economic inequality as well as wage stagnation?
Absolutely. I think you're absolutely right. I think we would like to, proponents of the law would like us to picture family-run Main Street businesses who are actually investing in increasing wages. But the fact of the matter is the bulk of the dollars are heading to the big banks that are posting record profits, the private equity firms that are reorganizing as corporations in order to get the corporate tax cut, the pharmaceutical companies that are getting big tax cuts without passing that on to their consumers or investing in the US. So overall, following those decades and decades of a larger share of the nation's income going to the top 1%, this tax law worsened that by giving bigger tax cuts to the very top than to people at the bottom and in the middle. And that in turn, as I mentioned in my opening, feeds racial inequities as well.
Thank you. Another point I want to touch on is the reality, again, real facts, that millions of taxpayers are now beginning to file their tax returns. And I received a note from a constituent, Kevin, from Las Vegas, Nevada, who wrote to my office and told me, this is the first year that my husband and I are filing married jointly. Our joint refund, which should be, in theory, have been higher than when we filed as single, since we both still deduct at the single rate. The GOP tax plan touted benefits for married couples making over $120,000 per year. But when we looked at the tax filing process, removing the married status and deduction, we would have ended up owing the government several $1,000s more. Can either of you speak to the reality that millions of Americans are now going to owe more in their upcoming tax filing because of the GOP tax scheme that was passed last Congress?
I think there's undoubtedly a lot of confusion around refunds and total tax liability. And that hasn't been helped at all by the rushed enactment and implementation of the tax law, along with some of these overblown promises that we've heard before. And I think overall we're hearing a lot of evidence that the public knows that the law overall is tilted towards the highest income filers. I think one of the key examples that I've seen of the misapprehension about what the law does is the repeated statements, for example, from President Trump and Ivanka Trump and Secretary Mnuchin about what families with children would get, this $2,000 increase in their refunds or their child tax credit, when in fact 11 million children in the lowest income families will get $75 or less, and millions more will get far, far less than the full $2,000 refund. So I think going forward, what we want to do is to actually fix that and prioritise those families so that they can see something of an improvement in their living standards.
Thank you. Gentleman's time has expired. Now yield 5 minutes to the gentleman from Georgia, Mr. Woodall.
Thank you, Mr. Chairman. Thank you for those 5 minutes. I don't know if you're going to go around for a second round of questions. I find when I want to spend my first 4.5 minutes making a point, it's tough to get to the good witnesses after that. I had something of value across the board. Ms. Pohl, I wanted to start with you. Did it ever dawn on you when you thought about what Congress was doing as we were trying our very best to get good tax policy, that when you read about those committee hearings, that it would be one witness from one side of the aisle and then maybe 3 witnesses or more from the other side of the aisle? Or did you think that it was not a stacked deck, but an even playing field, just from a distance back home?
No, I wouldn't have expected that.
I wouldn't have either, and it's certainly the way we ran the place when we were running it, and it's the way it is now. And I think that's a shame on some issues like this. I heard you say specifically you made different business decisions, positive business decisions for your employees because of the passage of the tax bill. I heard other witnesses say unequivocally that they worried employees were disadvantaged, not by the tax bill in general, but specifically because of those pass-through provisions that were targeted at your business. And that is a legitimate concern. Everybody cares about employees. Do you have a more valuable resource in your business than your employees? I mean, can you just go out and find new talent if you lose the talent that you have today?
No, absolutely not. We've got some specifics with truck drivers especially. I just lost one to a death. I'm going to have a hard time finding somebody in that position, and they are valuable. We welcome them to the Giddings family when we hire anybody, because that's what they are. They're our family, and they're our salespeople.
Not surprisingly, Dr. Gale made a good point when he distinguished between small businesses and young businesses. It's not about maintaining a business model that's failing. It's about growing a business model and providing more opportunity in the community. Not to put you on the spot, we hadn't talked about this. You come from a serial entrepreneur family. Would you describe yourself as a small business or as a young and growing business?
I would say we're young and growing, yeah. We're looking forward to more expansion.
I think of one of my constituent companies, Boehringer Ingelheim. It's a family-owned business, started in 1885. They have been a young and growing business since 1885. It's now a multinational company. They can do business anywhere in the world they want to do business. They just brought an additional 225 jobs to Georgia. This is a animal health sciences company. These are high-paying jobs. This is not a $15 an hour job, which is a great job to get. These are six-figure jobs that could have gone to Europe, could have gone to Asia, and are coming to America instead, because folks have a choice. Multinationals do have a choice. If you wanted to pick your business up and move it to Europe or Asia, I suspect that would be a much more challenging model. want to think about the women-owned businesses that Ms. Bruckner referenced. She's absolutely right. We crafted the tax code to focus on capital-intensive businesses because, Dr. Gale may be able to speak to this, because we believe that capital-intensive businesses had a higher multiplier effect. But yes, more small businesses are service-oriented businesses. When you think about your peers in leadership back home, have you heard that concern before? Folks who said, golly, those capital-intensive small business owners did get a special break that I didn't get in my service business?
I'm not really hearing as much of that, and at least in Iowa. I also belong to NABO, National Association of Women Business Owners, and so I've been active in that for a while. And a lot of what we're finding is when we're building, when the large companies are building, when we're building small businesses, we actually use their services. And so, you know, I think it's helping out all the way through. And of course, I look at using women business owners, and I support that.
Candidly, I have not read the $1 Billion Blind Spot. I'm now going to have to think through that, because I thought that was a perfectly legitimate criticism. And I wish, Mr. Chairman, we had more time to actually talk about individual improvements, what Dr. Gale said about generational inequities. I think that's critically important that we talk about. You know, Dr. Kotlikoff has talked about that on a regular basis in terms of how we measure tax input. And one thing that I'd like to get us to get back to, Mr. Chairman, lots of talk about consumers and lower income families being the stimulative effect in a tax cut. Certainly that is true, except the Tax Policy Center reports that the bottom quintile is, bottom 20% is paying a negative tax rate today for income taxes. The bottom 40% are paying a negative income tax rate today. I would be interested to come back and have the conversation. Of course, those dollars are stimulative. Should we do it through the tax code, or should we do it through the income support spending level? I'm one of those, Dr. Gale, as you are, that believe tax expenditures should be measured as spending programs, not as tax programs, and we have not accurately measured those in the past, Mr. Chairman. I look forward to that partnership.
Thank you for the idea. We'll consider that. I thank the gentleman. I now recognize Mr. Panetta from California for 5 minutes.
Thank you, Mr. Chairman. Ranking Member Womack, I appreciate this opportunity. And to all the witnesses, thank you for your time and your preparation, not just for this hearing, but what you've done to be at this hearing. So thank you very much. I'm going to pick on Mr. Gale, if that's all right. Just a couple questions for you, sir. And I'm sure you were probably aware of this, and you probably watched this hearing, but before the tax law was passed, you had a number of senior administration officials come actually into this committee and talk about the tax law and what they attempted, what they wanted to pass. And one of them was Mick Mulvaney. And I'm sure he was at that point OMB, or one of his many positions. I think it was OMB at that point. And he said, and when he testified in front of this committee, we assumed for the sake of doing the budget that the tax plan is deficit neutral, that removing the exclusions, the deductions, the loopholes would lead us to a deficit-neutral tax plan. The dynamic benefit is only counted one time, and that's toward the 3% economic growth. And I'm happy to explain that to you further if you like. What I'd like for you to explain, Mr. Gale, is have these tax cuts been deficit-neutral?
Every reputable organization that's looked at this has found that the tax cuts, lo and behold, reduce revenues. And that's including the macro feedback effect. And that's a very wide range of organizations. The Congressional Joint Tax Committee, the Congressional Budget Office, think tanks like the Tax Foundation and the Tax Policy Center, private modelers, everyone comes to the conclusion that the tax cuts will reduce revenues. There is, in theory, a growth rate that would be fast enough to offset all the revenues, but nobody thinks we're going to be anywhere near that growth rate.
In theory, what is that?
It's above 4. I'm not sure exactly what the right number is, but it would be great if we could grow at that rate. Sure. But and this comes back to the comments about imagination. And the anecdotes earlier, the anecdotes are inspiring, and we should all, be moved by our imagination, but there's no substitute for serious analysis.
Understood, understood. I guess in discussing analysis, I guess the CBO has done, obviously many analyses on this, and it has showed that the tax bill, even if it does expire on schedule, it will add 1.9 trillion, I think they're saying, to the debt by 2028 with interest and growth, obviously. And extending it this year would cost at least, I think, another 1.1 trillion through 2029.
Right.
What they're saying. In your opinion, Mr. Gale, and if any other witness would like to speak to this, can we afford a $3 trillion worth of tax cuts in this type of strong economy that we're experiencing right now?
There's two issues here. One is the size of the tax cuts, and the second is the allocation of the tax cuts. The size of the tax cuts are substantial. It's in the wrong direction as far as long-term fiscal sustainability is concerned. But if we had allocated the money really well to pressing national needs, then it might have been worth it to increase the deficit by that much. But TCJA basically says the biggest problem in the country is that high-income households don't have enough after-tax income. And so it's allocating enormous amount of that increase in deficit toward high-income households. Now, all the stuff about people buying a car seat or getting a job or getting other benefits, those are inspiring, and we should be doing that. But this is an incredibly poorly way to target those benefits. We don't have to pay off the top 1% of the population to give benefits to the bottom half.
And I think, Ms. Wang, you're shaking your head.
In vehement agreement, and I think the other part that Dr. Gale has also talked about is who ends up holding the tab for those tax cuts for the very top. And, we've seen over and over again in both the statements and the budget proposals of people who supported the 2017 tax law that their preferred way of dealing with deficits is to cut programs that, on average help families of limited means. Medicaid, cuts to job training and assistance, education programs. So that's also another worry that I think is part of the picture.
Thanks again to all of you. I yield back, Mr. Chairman. Thank you.
I thank the gentleman. I now recognize Mr. Crenshaw of Texas for 5 minutes.
Thank you, Mr. Chairman. Thank you all for being here. I want to thank all our witnesses again. And I always want to remind everyone what we're really here talking about. We're talking about a difference in philosophy. It's not just tax rates. It's a question of whether the government should be taking more of your money or whether you should keep more of your money. There's a difference in the role of government and what we believe. It seems to me that you all believe that the role of government is to tax the people as much as possible so that you and your benevolent fellow academics can dream up more programs for the government to spend money on. I don't believe that. I don't believe that's what the role of government is for. The role of government is to protect the God-given rights that we have and to ensure that we live as free as possible. The role of government is to tax people to the least extent possible while still taxing them enough to cover basic needs for government. And if we're questioning what those needs are, we can just look at our Constitution. They're generally pretty clear there. So that's what today's about. You said that these anecdotes are imaginative. It's literally not imagination to bring up anecdotes. It's literally not that. It's reality. So here's some reality from Texas. Direct results from the Tax Cuts and Jobs Act. McDonald's increased educational opportunities by $150 million as a result of the tax cuts. $500 employee bonuses at Camp Construction Services. Reduced prices for customers at CenterPoint Energy. $500 employee bonuses at Group 1 Automotive. $1,600 employee bonuses at Cabot Oil and Gas. $2,000 employee bonuses at Waste and Management. $1,000 to $4,000 bonuses paid to employees at Insperity, totaling $17 million. Base wages raised to $15 an hour at Cadence Bancorp, along with an increased 401k contribution and employee stock purchase plan. Covestro had a choice between 3 new facilities, a $1.7 billion facility between Asia, Europe, and Houston. So they chose Houston, and they say it's directly because of the tax cuts. These are not imaginative anecdotes. These are real. You said it. You said it. So
I said the anecdotes were
I didn't ask.
inspiring.
That's okay. That's okay. There's more money in the pockets of the people. That's the reality. Okay? Not imagination. Professor Bruckner, again, we're speaking about imaginative arguments. You acknowledge that there's a direct benefit of the tax cut to people across all incomes, but you're claiming women don't benefit as much. Is that correct? Yes or no?
No, I'm claiming that we absolutely should study this for the first time ever to determine what the impact is.
Okay, but would you prefer another tax cut for women entrepreneurs? Because we might find some common ground there.
No, what I'm saying is we should take a look at JCT's analysis and we should coordinate among our government resources to study where the distribution of the income is. Are we investing in where there's actual growth and opportunity for growth? Are we investing in businesses that will generate more economic activity?
Fair enough. On the healthcare issue, you took issue with the changes to the individual mandate. What we've gone over is that those estimates of people, quote unquote, losing their healthcare. Of course, it's not losing your healthcare. You're choosing a different healthcare plan. Do you not believe in giving people that choice?
I believe in creating schemes that provide a pathway for affordable health care for small businesses. It's their #1 concern. And I think that
Obamacare hurt small businesses, as we know. And I would just want to point out, the law gives people the choice. They're not losing something, they're choosing something else. And I got to move on because I have such limited time. Ms. Wong, you took issue with the 20% tax cut for small businesses. You're claiming that leads to lower workplace standards, that it encourages independent contracting. Do you not believe that small businesses...
Let's dig into what the definition of a small business is. If you look at the where the revenue
Yes or no? I mean, you don't want them to take that 20%?
More than 2/3 of the tax cut for pass-throughs went to the top 1%. Those are not businesses that I would...
Okay, let's talk about the 1%. So what is the fraction of total federal revenue that the top 1% paid?
What is the fraction of income that the top 1% gain?
That's not the
More
question.
Than the bottom
Okay, you
80%.
can't answer it? All right, well, I'll tell you what it is. It's around 37% according to recent IRS data. Is that fair? We talked about passing the FAIR test. So the top 1% pays more than the bottom 90%. Is that fair? And again, we have different definitions of fair.
Fair to cherry pick
Again, we have,
one
that's
type
not,
of
you guys have been
tax
cherry picking this whole
when
time.
Other people
I'm not
pay
done.
payroll taxes,
I'm not done because I only have 10
state
seconds left, and so I'm going to use it to make a point here. We have different definitions of fair, and that's okay, but I wish we were honest about that. You believe fair is proportionality. I believe fair is proportionality. You believe fair is egalitarianism. We have different approaches to governance, and that's really what this is about. And I hope we have honest conversations in the future. Thank you.
Just to set the record straight, Dr. Gale did not use the word imaginative. He called those inspiring. Actually, the imaginative came from quoting Mark Twain by Mr. Smith.
Okay.
I now recognize Ms. Omar for 5 minutes.
Thank you, Chair. Ms. Wong, thank you for your forthcoming testimony about the impact of the GOP tax cut to the American people. The details you shared were very insightful, though the underlying message you are sharing shouldn't be a surprise to anyone here. Clearly, the 2017 tax cuts were just a tool that our Republican colleagues used to help make their rich friends richer. As you illustrated, everyday working Americans haven't seen a dollar of the benefits that the Republicans and the Trump administration promised them. So promise is something that came up quite a lot, and I want to just go through some of those promises. There hasn't been any meaningful growth, wage growth, as they promised. We aren't seeing millions of jobs added to the economy as a result of the cuts as they promised. We aren't seeing a major economic boost, certainly not one that offsets the revenue decreases we are now facing as they promised. What we are seeing is a record $1 trillion in corporate stock buybacks. What we are seeing is major corporations like Amazon, a company that is valued at $800 billion, paying exactly $0 in taxes. So what is happening right now is we're paying off, as Dr. Gale said, we're paying off the top 1% on the backs of the rest of us. So these promises have been made, all while the American workers are trying to balance a skyrocketing healthcare cost, mounting student debt load, and impossible high childcare costs. Where are their benefits and where are their promises? These tax cuts aren't helping them pay those bills. In many cases, workers are seeing their wages go down while everyday cost goes up. So my question to you is, given everything that you have shared in your testimony, does the GOP tax cut do anything to improve the lives of everyday working families? Families like the ones in Minneapolis, families like the ones in everyone's district that we've heard about?
They are not, in my view, the priority of this tax law. I think actually something's gone seriously wrong when you have a $1.9 trillion tax bill and there are a single mother with 2 kids working full-time minimum wage who gets $75 from this law. And there are 11 million kids in working families just like her. So to really fix this and prioritise those working families, we could have and should have seen a substantial increase in the child tax credit and earned income tax credit for those working families. And that should be the first thing that lawmakers prioritise when fixing this law.
Thank you. And my colleague from Texas talked about rights earlier. I believe we have a right to breathe clean air. We have a right to have access to clean water. We have a right to have a planet we can live on. And a lot of my colleagues on the other side of the aisle talked about the Green New Deal. The Green New Deal is one that has economic growth and opportunity. A recent op-ed on the Hill called the Green New Deal is good for the economy states that while the Green New Deal is not going to be cheap, it's pale in comparison to the damage that unchecked climate change will inflict on the economy. Can you speak to what the costs would be if we are not investing in making sure that we have a planet we can live on?
Thank you. The right question about the cost of the Green New Deal is compared to what? If we are truly on an existential descent, then we should be doing a lot to try to offset that. That doesn't mean that's not carte blanche to do anything. We should be choosing the most effective interventions and most cost-effective interventions. But just as the Congressman was talking about imagination earlier in respect to the tax cuts, we should be moved by the potential to make the planet a cleaner place. That, again, that should not substitute for analysis of what works and what's the best way to do it. But the goals and the ambition that are laid out, I think, are exemplary.
And through taxes and subsidies, we could have economic growth and opportunity with the Green New Deal is what I...
Again, compared to what? If climate change, has increasing costs over time, then mitigating that climate change, we should get credit for that in terms of looking at the economic effects. So yeah, I think there is a positive outcome there.
Thank you. I yield back.
Gentlelady's time has expired. I now recognize the gentleman from Pennsylvania, Mr. Muser, for 5 minutes.
Thank you, Chairman, very much. And thank you, our guests here today, for your testimony. First off, I represent a district, PA 9th, where the median income is $43,000. I don't represent the rich. Secondly, as the former revenue secretary for the Commonwealth of Pennsylvania, I can assure you that Amazon pays a lot of taxes. A lot of tax revenue comes in from Amazon. I think earlier my colleague's main point that you guys wanted to try to minimize was about honesty and trying to get to the truth. I think that would be a honorable baseline to have a good conversation here with the Budget Committee that understands the budget and the numbers. So I'm certainly a little confused, call it frustrated, with what I'm hearing today from my friends on the other side of the aisle. what has been wrongly argued as the Tax Cuts and Jobs Act is responsible for this current budgetary deficit, first of all, is inaccurate. Right? The number's $150 billion and closing fast, by the way. And it is also inaccurate to say that this was purely a tax cut for the wealthy at a cost to the middle class. This could be nothing further from the truth. It's simply inaccurate and is not focused on reality and facts. The facts are the middle income taxes were reduced by 3 to 4%. The standard deduction doubled. Not sure if you know what that means, but $12,000 no longer is taxed of people's income. Small business did receive a 20% reduction. 75% of the people employed in my district work for small businesses. This was very important. Unemployment nationwide is lowest since 1969 in all demographics. Corporate taxes. We want to sit here and beat up on corporations. Corporations buy most of the products from small businesses. They work together. Our corporate tax, yes, it was reduced to 21%. However, if you are aware of this, Ireland's corporate tax rate is 12.5%, the UK is 19%, and Vietnam is 20%. We have to be competitive, and that is what is creating more investment and more manufacturing in our country, and it's happening. And the repatriation, but he just scoffs at that. It is getting near $1 trillion. It just doesn't happen overnight. So the goals of the tax cut are real. And, you know, I can't help but shake my head when I hear about all the woes and sorrowfulness of the deficit. You know, we spent 8 years where there was $9.5 trillion spent, and none of my friends on the other side of the aisle said a word about it. And frankly, what do we have to show for it? We're not much. So thanks to the tax cuts that were signed into the law last year by Republicans, not one Democrat voted for it, businesses large and small are increasing wages. That data's in too. They're hiring more workers. They're investing in growth. There are many, many good American business stories in my district. Every day I hear from a contractor or a builder or a store that tells me that they're doing better. Can we do better? Absolutely. And that's why I'm in Congress, to help that effort, to help create a more competitive environment. Government's role is not to create jobs. Government's role is to create an environment where the private sector creates the jobs and drives disposable income and overall incomes of the people. I want to give an example of one success story in my district. It's a company in East Central Pennsylvania by the name of Ashland Technologies. I asked them if we could speak on their behalf, and they were very excited at that prospect because they're very proud of what's been done. Thanks to the tax reform, Ashtec was able to open a new manufacturing facility, hire 20 new workers, and purchase nearly $2 million in new equipment thanks to the 100% depreciation just in the last couple of years. This is an area where unemployment, good paying jobs, we needed impetus such as this. So I have a question for Ms. Paul. Ms. Paul, would you say that your business record over the last several years has been similar to the one that I referred to as from Ashtec, hiring, expanding?
Absolutely.
That's great to hear. And with my last couple of seconds, can you provide any recommendations as to further tax changes that would benefit a business such as your own?
Well, in our business, one of the ones that would be great is the depreciation on buildings, because I have so many of them. You know, it's over 39 years, and that's a long time to depreciate out a building. So that's one that kind of relates to me.
Great. Thank you for your testimony. Thank you, Chairman. I yield back my time.
Thank you. Gentleman's time has expired. And now recognize the gentlelady from Illinois, Ms. Tchaikovsky.
Thank you, Mr. Chairman. I ask unanimous consent first to put into the record a one-pager from the Center for Budget and Policy Priority called 2017 Tax Laws Pass-Through Deduction Could Encourage, quote, workplace fissuring, unquote.
Without objection, so ordered.
Let me just say to my colleagues, I really don't think we ought to get into only you're telling the truth, and we are not. We may have different interpretations of the data, but the idea that somehow we're not telling the truth, we're not dealing with facts, I think is a dangerous place to go and unnecessary. The White House Council of Economic Advisors said the 2017 tax law would raise the average worker's wages about $4,000 to $9,000, claiming the main wage suppressant over the last 40 years, when their economic policies have been enacted, has been international competition in terms of low tax rates. Instead, though, what we've seen are companies investing more than $1 trillion in stock buybacks. That's over 130 times the $7.1 billion corporations have given workers. Dr. Gale, have workers seen $5,000 more, somewhere around there, in their paychecks as a result of the tax cuts and the Jobs Act?
There's certainly no evidence to date that workers' gains have been anything near the 4,000 to 9,000 that the CEA claimed would occur. It's unclear from the CEA's analysis what the time frame for their analysis is, but as I noted earlier, CBO says that national income will only go up by 0.1% after 10 years because of the tax cut. This is facts and analysis, by the way. It's hard to see how wages would go up by the 4,000 to 9,000 above what they would have gone up anyway if national income is only going to be 0.1% higher than it would have been anyway.
Doesn't add up, does it? Let's look backward here. Ms. Wang, did the wealth trickle down to workers in the form of wage increases after the 2003 Bush tax cut?
The historical record is pretty poor on that.
So, Dr. Gill, did the wealth trickle down to workers in the form of wage increases after the 2001 Bush tax cut?
The 2001 featured both similar cuts to 2017, income tax rates and estate tax rates, and then there was the repatriation holiday a couple years ago. Wage growth was fairly slow in that period. You certainly don't see a big boost in worker compensation at that point. In particular, in the repatriation, there's strong evidence that firms, if you recall, the law then said that firms could not get the tax holiday for the repatriation unless they invested the money. They couldn't get the holiday if they used it for dividends and buybacks. But subsequent evidence shows that the firms that got the subsidy used it for precisely those reasons, dividends and buybacks, rather than job expansion.
Was that in the law, that they were supposed to?
That was a provision in the law back during the Bush administration, yes. Of course, money is fungible, so they basically said, well, this money we brought back, we're going to pay to workers, but this other money, which we used to be paying workers, now we're going to pay out to shareholders.
I see. Ms. Wang, are you aware if the wealth trickled down to workers in the form of wage increases after the 1981 Reagan tax cut?
No, and you can look back at many different examples, including that one, including the experience in Kansas, and there's very little evidence that these tax cuts for high-income people and large businesses end up in workers' wages over time.
So I guess in general, I'm asking both of you if there are any examples that you can find that trickle down, that is, cutting taxes for the wealthiest Americans has actually improved the lot significantly then, or equally, of ordinary working families. Mr. Gale, Dr. Gale.
Thank you. My reading of the literature is there's an enormous amount of evidence, whether it's cross-country evidence or historical evidence in the U.S. That says that trickle-down economics falls far, far, far short of what's claimed for it.
Thank you. I yield back.
Gentlelady's time has expired. We have one more Republican who is on his way back to testify. So the ranking member agrees. We'll yield to Mr. Sirius for his 5 minutes, and then, well, I mean, here's Mr. Burchett. Are you?
Go ahead.
All right, Mr. Series, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you for the witnesses that have been here today. Look, I'm from New Jersey, okay, a very high tax state. We probably got hit harder than any other state with this tax bill that was passed last year. I am very concerned about what's happening in terms of the real estate market and how it is impacting the real estate market. You have people in my district is across from New York City. We get the overflow from New York City. They are high wage, they make good salaries, they come to New Jersey, and they pay a lot of taxes, especially in the real estate market. New Jersey benefits greatly from that. I'm starting to get a lot of questions from these people who are making good money, that they're starting to go to their accountant. They're starting to realize that their taxes may be $25,000 a year, $30,000 a year, and it's capped at $10,000. So some of them, this benefit that they're talking about, it's offset. And then we also have a state tax that is also capped. So I think this tax bill stinks, quite frankly, in terms of New Jersey. I think this tax bill was put together, they rushed it, they didn't look at the impact that some of the states were going to have, and obviously impacted a lot of the blue states. And quite frankly, I think we have to change it. I think it's going to hurt the real estate market in New Jersey a great deal after they filed this year, because people are starting to realize that they cannot write off what they've been writing off in the past. And I know some of the realtors are already making appointments in my office to say this. I've seen it slow down. I talked to some of the mayors in my district. They're very concerned about the tax bill and how it's going to impact their municipalities. They're concerned because they're not going to be able to move some of this real estate that's been going. The district that I represent, they called it the Gold Coast. You know, Hoboken, the whole area where there's a lot of development, a lot of good real estate has been developed. So, you know, how do we correct this? Do you think that this tax bill aggravated the real estate market in some of these areas? Can anybody talk to that? In other words, has aggravated the downturn in home sales in certain regions of the country?
It certainly did in a couple of ways. The shift from personal exemptions to standard deduction greatly reduced the number of people that took the mortgage interest deduction. So the number of people taking that deduction is falling from on the order of 26% to on the order of 11%. I'm not sure those figures are exactly right, but it's that type of thing. And that, of course, will have ramifications for the value of real estate. The state and local tax deduction limitation, as you mentioned, will also have a similar effect in the high tax states. So, I mean, this is, I don't want in any way to minimize the problem. This is just an example of when you change a lot of things change. Some go up, some go down. And it seems real estate, charitable giving, health insurance, things like that are among the losers in this tax reform.
Anybody else? No?
I think that it's definitely something we should measure and study after this first year of tax filing. Let's get a precise number on whether or not people benefited with respect to the real estate provisions. I think it's something that certainly should be flagged for further study.
Well, some people estimate that as many as 2 million people in New Jersey are not going to be able to write, you know, the real estate tax above the $10,000 that they were writing before. And in my district, I have 10 minutes, but what was good about it is the people used to come to New Jersey because they realized that they could write that off because of all that they made high wages in New York. And now they can't.
I would be worried and interested in looking at the data on older people and older people who are still in their homes.
We haven't gone into that, but obviously they are impacted greatly.
That's something that, and there's not data on that, but it's something certainly to track.
Thank you.
The gentleman's time has expired. Now recognize Mr. Burchett of Tennessee for 5 minutes.
Thank you, Mr. Chairman, Ranking Member. I do want to, everybody's wearing orange today. I want to thank you all so much for recognizing the University of Tennessee and our upcoming victory over Kentucky this weekend. I just want to make note of that. Ms. Bruckner, I'm not going to ask you any questions due to my collegiate history and accounting, so I'm going to stay away from you, all right? As I stated many times, I like first quarter accounting so much I took it twice. So, and then I pursued a degree in education, so thank you. I guess, let's see, on the screen, yeah, Litton's Restaurant. That's owned by my buddy Barry Litton. He, like my father, he served his country in the Marine Corps. He and his son Eric and Barry's sister, they just run a great restaurant. If you ever come to Knoxville and get near Fountain City, just ask somebody where Litton's is. It's wonderful, and it's a great restaurant. And they have, as they've told me, they've actually seen an uptick since the tax break, and they're very grateful for it. And it is a small business in Knoxville, just like 99% of the businesses in Tennessee are. And I want to ask Ms. Pohl, is that, how do I say that name? Pohl? Okay, great.
You're right.
In your opinion, you're the only small business owner on the panel. That seems to be correct. How has the new tax law helped you? And just give us specific. You know, everybody gives these numbers and statistics, and frankly, I get lost in all that. Just I deal with human interest and things like that. Mm-hmm. And thank you for being here, ma'am.
Yeah, absolutely. Thanks for having me. The biggest thing was being able to feel confident to give raises to our employees this past year. We've struggled with that the last few years just due to healthcare costs. It's one of our major concerns. And so we were able to give every one of our employees a raise. And, you know, being able to get money back on the new tax law as far as the small business deduction, that's helped us invest. And we invested in a warehousing house, $2 million, and then also doing the $500,000 to the $1 million allowed us to invest in 6 new trucks that it cost $1 million. And so we haven't been able to do that for the last few years. But it gave us confidence going forward, plus the spark of new businesses and new business that's coming our direction because of the boost in the economy all the way around our area.
Great. Thank you so much for being here, ma'am. And is it Mr. Gale or is it Dr. Gale? Doctor? All right, doctor, you earned it, so I'm going to call you that. In the energy sector, what type of taxes would you support? Would it be a carbon tax, a gasoline tax? And if so, what's your justification? And I'm not going to jump you. I'm not going to run for re-election on this.
I think the right approach is the carbon tax with an exemption for low-income households or a rebate for low-income households. One of the numbers I came up with recently was that we could pay every coal worker $250,000 in severance pay, and the total cost would be 1% of the 10-year revenue of a carbon tax. So the impact on low-income communities is important. The impact on coal communities is important, but they are totally solvable situations. The advantage of a carbon tax over a gasoline tax is that a carbon tax taxes many forms of carbon emissions, whereas gasoline is just one of them. So as broad as base as possible, a carbon tax, I think, is the right thing to do there, and it would not only help the environment, it would help the fiscal situation, and it would fix a big imperfection in the way the economy operates, which is right now people and businesses that emit carbon are not paying the full social cost of that carbon emission.
Are you familiar with this isn't in my notes, this always makes my folks nervous when I get off track, but I always get off track, so it doesn't matter. There's a new bill out. Have you seen it, the one that, I had a group of people in Knoxville just last week come to, when you said that, it reminded me that they came to see me about that bill. It's a new type of idea that actually gives rebates to folks. And are you familiar with that legislation?
I'm not sure about the legislation. There was an economist's statement that was signed by a couple of dozen Nobel laureates and about 3,000 other people, including me, saying that we should do a carbon tax and we should rebate the money on a universal basis. That's my second choice. I signed it because it would be so much better than what we're doing now. My first choice would be we use the revenues for a variety of purposes, but the main issue is to get the carbon tax in there.
And I know I'm out of time, but do you actually trust government with another pool of money that they will actually do with it what they said they will do?
Compared to what, again? I feel like we have to tax carbon, and then the question is what to do about it. The paying back, the people who want to pay it back mention precisely the issue that you mentioned, which is they don't trust government to use it, so they want to send the money back. I trust government more than that. I think we can reduce the debt, we could reform taxes, et cetera.
Okay, thank you. And
Gentleman's time has expired, and now recognize Ms. Jackson Lee of Texas for 5 minutes.
Chairman and Ranking Member, thank you very much. I've always indicated my appreciation for this committee because of the astuteness of all the witnesses. Let me acknowledge Ms. Pohl, who's come a distance to share her story, and I think I have most of the facts of her story, and I thank her so very much for her testimony. But I think it's important for me to set the groundwork very quickly to indicate, sadly, that this GOP tax scam is a failure. It raises the nation's debt by $1.9 trillion at a time when the economy was already strong. I lived through the 2009 debacle. In fact, I was a part of the discussion when the Secretary of the Treasury came late to the Congress to indicate, and that was, of course, some years before, that we were about to see a collapse that we had never seen before. That was Secretary Paulson. And so I've seen the trajectory and saw what we needed to do, an infusion of capital that many criticized, but the stimulus saved a lot. Long-term budgetary challenges driven by our aging population, and rather than devoting resources to wise investments in our workers and small businesses, the GOP tax scam further burdens workers, families, endangers Americans' retirement security, and worsens our budgetary outlook. Mr. Chairman, the verdict is in, and none of the GOP tax scam promises have borne out. Our long-term economic growth trajectory is unchanged. There's no sign of an investment boom. Real wage groups for workers remain modest, and factories and jobs are more likely to go overseas. The federal deficit is soaring. We have the sequester and corporate tax receipts plummet into the government, and the tax code is riddled with even more special interest tax breaks and loopholes. As I quickly ask you a question, in testimony before one of our committees dealing with pharmaceuticals, the question was asked, have you taken the tax savings and invested back into research, which would then help bring down the cost of prescription drugs? To my knowledge, let me qualify my recollection, that not one said that they had invested those tax benefits to any of us. Let me immediately go to Ms. Bruckner and my first question, and that is to, if I can, Professor Bruckner, what do typical women-owned firms look like in terms of their type, size, revenues? Did the GOP tax law address typical women business owners' needs in terms of accessing capital and growing their businesses, in particular women of color? May I just do this? If your memories are good, might I just quickly go to, excuse my papers here, go to, so you can remember, to Ms. Wang. Some of my friends across the aisle have already been rehearsing their calls to pay for the tax cuts by making cuts to Social Security, Medicare, Medicaid. I just came from a Medicare for All presentation. Who will be hurt if we pay for the tax cut that way? And what would this mean for Americans' retirement security or their access to good health care? And to Dr. Gale, are we experiencing a Trump economic boom or simply a continuation of the Obama expansion beginning in 2009? I've given you only a few seconds, but I know you're succinct because I need to get all three of you. Thank you for your presence here.
I think that when we look at the business tax expenditures and how they were distributed among women business owners, there's a real question as to whether or not there's an equitable distribution, particularly when you measure it in terms of the revenue loss. For example, 199 Cap A cost $415 billion, but more than 50% of that is going to go to firms that have $1 million or more of revenues, but only 1.7% of women business owners, who are 40% of all U.S. businesses, actually have revenues of $1 million or more. That's just one example that warrants the specific study of tax expenditures. Congress needs to know if where you're investing, you're getting a rate of return, and women business owners tend to start businesses more.
Thank you. Quickly, Ms. Lang. Yeah.
There's a big risk that low and moderate income Americans end up being worse off by this tax law if the increase in deficits from those tax cuts, primarily for the wealthy, end up in underinvestments in basic infrastructure, childcare, facing challenges like climate change and the aging population. And in fact, we've seen budget proposals from proponents of the tax law that would cut supports in housing and healthcare and in a variety of other programs that help Americans achieve shared prosperity.
I thank you. Dr. Gale?
All right, I think there are 5 things that are affecting the economy positively right now. The first is that we've been building on a long economic boom. The second is the tax cuts have definitely had a positive stimulus effect in the short run. Almost any tax cut that put money in people's pockets would do that. Third, the 2018 spending deal that Congress reached has helped boost the economy. Fourth, oil prices have gone up, and the U.S. is now a net supplier of oil, so that helps the economy, whereas it used to hurt the economy. And fifth, the Fed has indicated that it's going to ease off on interest rate hikes, which also helps the economy. So the tax cut is part of that, but I wouldn't give all credit for everything positive to the tax cut.
And it's countered by the deficit that's growing.
That's a longer-term effect, and over time, the stimulative effects of the tax cut will wear out, and the long-term effects of the deficit will get bigger, and that's why CBO predicts that by the end of 10 years, there'll be virtually no impact on the size of the economy.
Great. Gentlelady's time has expired.
Thank you, Chairman.
And so it's now down to the ranking member and me.
As it usually is.
It is. The ranking member is recognized for 10 minutes.
I want to thank each of the witnesses that have been before us today, and thank you, Mr. Chairman, for having this hearing. Some of my colleagues on the other side of the aisle and some of the witnesses have talked about how the Tax Cuts and Jobs Act has led to income inequality. Let's just review some facts, and if these are incorrect, you please take issue with them. Median household income is at an all-time high. More people than ever live in households earning $100,000 or more, fewer households earning less than $35,000. Share of income as it pertains to the top 5% of income earners has remained the same since 1995. And the share of income as it pertains to the top 20% of income earners has remained the same since 1995. So I struggle with the claims that the Tax Cuts and Jobs Act has led to a bigger gap in income inequality. And my thesis going in my opening statement was about that Washington, D.C., the federal government, has a spending problem, not a revenue problem. Revenues are up, but spending is up on a much bigger percentage of GDP. So, and then I want to go back to what was said earlier, and I think it's worth coming back to, and that is that, Dr. Gale, you said you had created some jobs for some contractors, but in terms of, let's just say risk, business risk, what risk have you taken? You've read a lot of literature, but what risks have you taken that give you some inside view, some more than just a theoretical view, but what risks have you taken, what jobs have you created that give you authority on the subject?
One of the biggest professional risks that I took was opting to pursue a PhD. That's a long process. It's not always a successful process.
Did that create any jobs?
You were asking me what risks I was taking. My point, if you'll let me finish, is that
because I got a limited amount of time, let me reclaim my time. Have you created any jobs?
Depends what you mean by created jobs.
Have you had to negotiate a health care program? Have you turned the key in the door? Have you had to buy equipment and hire people?
When I was the head of the Economic Studies program at the Brookings Institution from 2006 to 2009, the program
you supervised
tripled in size,
size,
and we funded that increase.
And that was someone else's money. It wasn't yours.
We raised, no, it was not my money. I don't personally finance the Brookings Institution.
All right, Ms. Hong, question for you.
Raised the money
how many
externally
jobs
and
have you
hired
created, Mr. Hong, Ms. Hong?
So I think the premise of the question that you're
No,
getting,
it's a real simple premise. How many jobs have you created?
well, I think it's
What
also simple
health
to
care programs have
understand
you let me finish my question.
That workers who take home a paycheck
Let
and
me
work
finish.
hard
Let me
in this
finish my
economy
question respectfully. All right.
for low wages and
So-
spend that money are also part of what keeps this economy vibrant.
Okay. My question is, you're an expert witness on the Tax Cuts and Jobs Act, sitting before the Budget Committee of the United States House of Representatives, and a member is asking, how many jobs have you created? That gives you more than just some kind of academic background on the impact of the Tax Cuts and Jobs Act. How many?
I don't know. I don't know.
Have you created any? Have you created any
jobs?
jobs?
I don't know.
Okay, the witness
what
is not
impact that had
cooperating,
throughout
Mr.
the
Chairman. I'm
community.
just,
I don't know
let's
when
turn
I
to
was
Ms.
advising
Bruckner.
startup
Ms. Bruckner,
businesses,
you
what
did
that
have
impact that had
some kind of
throughout
a
the economy.
previous background and some kind of a job creation situation, did you not? How many jobs were created?
I am not a business owner yet.
Okay, so I think it's safe to say that of the panelists here today, and we have four, that of the panelists here today, to critique the Tax Cuts and Jobs Act, to put under impeachment, if you will, the very premise that the Tax Cuts and Jobs Act is working, as evidenced by the fact that unemployment is low, wages are higher, and we've gone through the whole litany of the benefits of the Tax Cuts and Jobs Act, that 75%, 3 out of the 4 witnesses here today, haven't created jobs, haven't negotiated a health care contract, haven't had to deal with signing the front of the check as well as the back of the check. These are people that spend most of their time in academia through some kind of a bureaucratic maze, reading a lot of numbers, a lot of literature, writing a lot of articles about it. But where the rubber meets the road, the only witness that is standing or sitting before this committee today is Ms. Paul from Iowa, flyover country. Ms. Paul, how many jobs have you created?
Currently, we have 54 employees.
54 employees, and where did you start?
We started with one, my father.
Okay, so, and as my friend Mr. Woodall characterized you, you're kind of a serial entrepreneur. It dates back into years. So, Ms. Paul, I would trust that somebody that has actually been in the business of creating jobs and opportunity for their people has a kind of an inside baseball look at what Tax Cuts and Jobs Act provisions have done for your business. So would you, just in a matter of a few seconds, kind of give me a highlight as to what it was able to do for you that you would not have been able to do otherwise?
Sure. As I've spoke before on that, we spent $1 million, and that helped to be able to, to deduct that immediately, expense it out immediately instead of depreciating out. Really, really helped us tax-wise this year. I'm in the process of buying my brothers out, so I have a huge debt load on myself. When we spent that money, we also borrowed money, and also the same way at the warehouse. I'm not a wealthy person, even though we have these companies, we get back to the community, we get back to our employees. And so by doing this, we needed to do it, but it was scary to do in our position where we are financially with our company. And so having to be able to have these deductions and the help on that and to getting some cash flow back into our company kind of revitalized us.
giving you hope
Yes.
for the future?
Absolutely.
Are you still thinking expansion, thinking of hiring more people?
Yes, yeah. I'm scared of the future for the fact that it's not permanent. That's what scares me going the next generation.
But to be fair, I would also say that it's not just tax policy. There are a lot of other inputs rather than tax policy, cost of energy and competition for labor and a whole lot of other things. But I'm going to take it that in your response, you're basically saying that the Tax Cuts and Jobs Act has helped you, an individual business owner in small town Iowa, actually help your cause, help your business.
Yes, it has.
Question for Dr. Gale. CBO Director Keith Hall testified before this very committee on a question that I had raised about elevating the corporate income tax, because there is a movement afoot, or at least a theory that we need to, we went too far. We took it to 21, we cut it 14 points, and we need to move it back up. My friend right here from the great Commonwealth of Kentucky thinks 28 is the right number. Director Hall said that it would lead to the inverse of what we've seen in the passage of the TCJA, and that is we would see declining growth and employment. Do you have concerns about what would happen if, in fact, the corporate rate went back the other direction?
I have no interest in disputing what Director Hall said. I would emphasize that the changes to the corporate tax should be not just to the rate, but to the base. If we expanded the scope of expensing, we would encourage new investment and hence encourage new jobs. And by raising the rates, we would reduce the windfall gains that are currently accruing to people who made investments in the past. So I would encourage something that raised the rate and transformed the base. But I think Director Hall is right. If you just raise the rates, you would undo some of the positive effects.
All right, quickly, Ms. Hong, and I know I'm going to be out of time here in a minute. If you follow your Twitter feed, it's obvious that you have an interest in a lot of things that involve spending a lot more money. So maybe the basis for your arguments about Tax Cuts and Jobs Act not working is the fact that allowing more people to keep more of their money prevents the government from having more of their money, which allows the government to provide more things. And you're big on a wealth tax, are you not?
I think that there's a lot of room and a lot of different ways to raise progressive revenues to meet the fiscal challenges that face this country.
You like the wealth tax, don't you?
I like a lot of different approaches.
What about the Green New Deal?
I don't know the details.
What about free college?
I don't know the details of that either.
What do you think about policies about work requirements for people that are on the social safety net program, that are not employed, that are single people without dependents and able-bodied? What do you think about that policy?
Many people who are beneficiaries of Medicaid and food stamps are in fact workers, and those social safety nets are actually very important because they help people over time do well in their homes and in their communities and be able to work. So I think it's actually really counterproductive to require paperwork tests that would increase the number of bureaucratic hoops that they would have to go through to get that basic assistance.
Appreciate the witnesses. Thank you.
Thank the gentleman. I now yield myself 10 minutes and begin by saying that ranking member is truly a friend, and I have great respect for him, as I do for all the members. And the strategy here from the other side has been very clear. It's been to try and discredit experts who have spent years doing research and analysis of very important topics, and to hold up individual examples of business people for whom the tax cuts have been helpful. And we understand, obviously, that the tax cuts have helped some people. My college classmate, Steve Schwarzman, who's the chairman and founder of the Blackstone Group, was helped substantially by the tax cuts. He made $700+ million last year, and I'm sure he's very happy with the Tax Act of 2017. I started several businesses. I unlocked the door. I negotiated healthcare contracts. I worried about who was making payroll. I was always the last one paid. My brothers and sister and my father all were entrepreneurs. I don't think any of them, well, possibly my father, but I don't think any of the four of us siblings who have started businesses and run businesses would have ever said, we are the definitive answer to the impact across the country of a certain policy of the federal government. I never would have been as presumptuous to say, because a policy had certain impact on me, that I know what the impact on the federal budget was. And that's, of course, what the purpose of this hearing is to determine what the impact of the tax cut has been and will be on the federal budget. So let's focus on that for a second. And there seems to be a substantial difference in a very important question in relation to what the impact on the budget is. Republicans say, and I'm not disputing that they're wrong, that revenues have never been higher, the federal government, as they've been since the tax cut was passed. We Democrats say, and some of you in your testimony have said, revenues have been hurt by the tax cut and will continue to be hurt by the tax cut. How do you reconcile those two, assuming they're both true, and I actually do believe they're true? Dr. Gale, would you like to reconcile
Again,
those?
it's a compared to what question. Revenues would be higher if we had not passed the tax cut. That seems like a very clear conclusion from everything CBO and JCT do, and I'm sure when Director Hall testified on that, that was an implication of his testimony. But, you know, the economy grows over time. There are more people, so there's more productivity. So, you know, there's a natural upward trend in the level of revenues. That trend was simply displaced somewhat by the tax cuts.
Ms. Wong, you want to answer?
As a share of the economy, which is really what the nation can afford in terms of its resources, revenues as a share of the economy are at its lowest level in 50 years outside of a recession.
And the fundamental conclusion or estimate of CBO that the tax cut specifically is going to be responsible for an additional $1.9 trillion worth of debt over 10 years, assuming the law stays as it is and a higher amount if we extend the expiring tax cuts. That hasn't changed, right?
Not that I'm aware of.
Okay.
And in fact, the 1.9 trillion, there was a question earlier, the 1.5 was the initial estimate, the 1.9 is the re-estimate based on later data in terms of how much it will cost.
Mr. Womack talked about how, and again, I have no reason to dispute this, that income levels haven't substantially changed in terms of percentages over the last decade or so. What about wealth? I didn't hear him talk about how wealth has changed, the disparity in wealth over the last decade or so.
Both income and wealth have become more unequally distributed in gradual processes over the last 40 years. The sources of the widening distribution have changed over time, but the trends are evident. The wealth trends are even starker than the income trends in terms of how much has been concentrated in the top 0.1%, 1%, et cetera.
Getting back again to a question of not so much impact on the budget, although all of this has an impact on the budget, but we talked about the question of fairness early on. I believe it was Mr. Crenshaw was talking about fairness. And one of the things that occurs to me is that we have a fundamental issue, philosophy, as to whether we tax rental income or productive workers' income differently or similarly. Does anybody want to address that? You know, I'm looking at these enormous incomes that we're seeing, and many of those people are in the top 0.1% who derive such a huge benefit from this tax cut. And it seems to me that many of those incomes are derived from essentially rental, with what's referred to as rental income. They're basically not doing anything on a daily basis. They're getting royalties, they're getting dividends and so forth. Dr. Gale?
Thank you. Perhaps the primary concern with this Section 191(9) provisions and the pass-through provisions is that it taxes business income at a lower level than wage income. That gives people incentives to shift wage income to business income, which is an obvious form of tax shelter. It gives businesses incentives to either divide or combine to take advantage of the odd limits in the bill. It's incredibly complex, and these are concerns with the provision. There's no doubt that particular small businesses have gained from it. They got a tax cut. The question is it a well-designed tax policy? And by every principle we know of well-designed tax policy, the answer is no.
Is there any justification you can think of to maintain the carried interest tax rate, which President Trump claimed that he was going to do away with, but unfortunately, from my perspective, is still part of the law after the 2017 Act?
I think it's pretty clear that carried interest should be taxed as labor income, not as capital gains. But in terms of taxing wealthy households and raising revenues, there's actually not much money in carried interest. There's much more money in wealth tax, taxing capital gains at death, undoing the 199 features, and so on.
Okay. One final question. And I'm really struck, Ms. Bruckner, by the amount of small businesses, the number of small businesses generating, and probably these are all new small businesses, growing small businesses, or young, is that the word, small amounts of income, and the lack of capital that they're dealing with. Isn't one of the issues here in terms of the fact that when considering that very few businesses, actually big businesses, when they got the corporate tax rate, and by the way, I'm not necessarily saying 28% is the right number. I said Obama was willing to go to 28% when the corporate tax rate was 35. I think we could afford some additional taxes. 28 may or may not be the right number. But anyway, one of the things that I've heard is that there is so much cash in the economy right now, in corporations, they have so much liquidity that giving them more was not going to make them invest, because if they had had opportunities to invest in productive activities, additional ones, they would have had the money to do that. At the same time, we have this problem with so many young small businesses not being able to have access, and this tax cut did nothing to help them. Is that kind of a fair reading of where we are?
I think with respect to small businesses, the quickest and most efficient place that you can get any kind of equity infusion is from your profits. And one other way that you can do that is from lower taxes. And I don't think that there's a question that most businesses got some sort of tax cut, right? The bill was designed that way. But when we're looking at questions of equity and fairness, are we looking at, we need to consider questions about, did we create lower taxes for the businesses who needed it most versus for the businesses that might have been otherwise just as profitable? And I think the question really is, with larger businesses, you're seeing lots of share buybacks, which is a way to increase shareholder value without having to actually pay dividends, which is a lower tax kind of strategy, versus, very, very small businesses that are desperate for access to capital, have trouble securing outside financing, and might have needed a greater share of tax breaks. I'm not saying that tax breaks are bad. I'm saying we should be investing tax breaks where we think, and we should study where they think that we're going to have the most bang for our buck, and we haven't been doing that.
Well, that concludes our hearing. I want to thank all of the panelists for all of your testimony. Thank you for traveling so far, Ms. Paul. We appreciate your being here. Please be advised, members can submit written questions to be answered later in writing. Those questions and your answers will be made part of the formal hearing record. Any members who wish to submit questions for the record may do so within 7 days. I thank the ranking member once again, and without objection, this hearing is adjourned.